Investors are saying that everything is awesome and there's not a lot of risk.
We have a stronger stock market at this point. So that does embolden the president to go forward and be more aggressive now.
There will be very big differences if the tariffs come out at the higher level.
What the market is telling you is that, yes, we're expecting volatility.
We could spend a lot of time thinking about the noise, the volatilities out there. It hasn't paid off to just say, I'm going to stay off the markets.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, full court press.
I think if Jerome Powell stepped down, it would be a great thing. I don't know that he's going to, but he should. Jerome Powell's been very bad for our country.
The Fed has a lot to answer for. What we need is regime change at the Fed. It's about breaking some heads because the way they've been doing business is not working.
Fed Chair Jay Powell facing pressure from all sides in Washington, D.C. As President Donald Trump ramps up the rhetoric on trade partners, equity markets are facing down a week absolutely full with event risk. Bank earnings and CPI are just around the corner.
Yeah, you know, it's often we come to the week and say this is going to be a big week. This one truly will be pivotal because we'll understand how tariffs are getting trickled out, whether it's with consumer prices, with CPI, or whether it's a hit to corporate earnings from some of the earnings that we get across the board. And that's not even including the increasingly heated discussion around tariffs, what the tariff rate is at a time where Jay Powell said that he had to hold off until he had some certainty around just what the level of those levies would be.
This week is a big week. This weekend was a big weekend. Equity futures are down just 0.25% on the S&P 500. Bond yields are higher by about a basis point.
And it's a big weekend considering the president came out when it comes to the European Union and Mexico saying there's going to be a 30% tariff rate. I look at what Kevin Hassett said, though, over the weekend, the NEC director. He says, well, you know, these tariffs are real if the president doesn't get a deal that he thinks is good enough. But, you know, conversations are ongoing. It feels like the president, 2.5 weeks out from August 1st, is still right now in negotiating mode.
Pressure up on trading partners, pressure up on Chairman Powell. What is the price of firing Chairman Powell? George Saravelis of Deutsche Bank with this to say. What is the cost if you were to force Powell out of his job? The next 24 hours would probably see a drop of at least 3 to 4% in a trade-weighted dollar, and for bond yields, a move of 30 to 40 basis points in a fixed income sell-off.
So it goes to really the implication that you had. We had all of these fireworks over the weekend, whether it's around finding backdoor ways to fire Jay Powell, or whether it's the increased rate that was given to the European Union and to Mexico. Why are stocks not responding? Why are we not seeing yields in the United States creeping higher than they are just globally with a global bond yield sell-off? These are some of the big questions that I have. Why are people so sanguine at a time of such heated rhetoric?
Markets are looking through the threats. Now, is it justified based on experience, or is it complacency going into a big week ahead?
Well, Trump feels encouraged, and he said this to NBC News on Thursday. He said they think the tariffs have been well received. The stock market hit an all-time high today. So basically, he's looking at the market and he's saying they're not pushing back. We saw him reverse course when the markets pushed back. They haven't yet, so he feels almost emboldened. And when it comes to Jay Powell, they're going after what the Fed is doing in terms of refurbishments, and they're calling it Versailles. This has been going on for a number of weeks now. But I think the real issue this administration has right now is that when you repeatedly hear from Jay Powell about whether or not he'll stay on after his chairmanship is ended through 2028, he doesn't give an answer, and I think that bothers them.
Lots of drama over the weekend. No drama whatsoever this morning. Equity futures down by about 0.25% on the S&P 500. Coming up this hour, we'll catch up with Peter Tchir of Economy. As President Trump escalates tariff threats, we'll speak to the former senior White House trade advisor Kellyanne Shaw on the EU's response, and Leo Feler of Numerator as investors await key inflation data. We begin this hour with our top story. President Trump threatening 30% tariffs on the EU and Mexico. Our team coverage starts right now with Bloomberg's Brendan Murray from London, Tyler Kendall in Washington, D.C. Tyler Kendall, what is the latest on the trade front?
Yeah. Hey, John. Good morning. Well, two fresh tariff threats over the weekend, as you were discussing, 30% now for Mexico and the European Union. When it does come to the EU, we heard from their chief trade negotiator earlier on this morning, who did confirm he has plans to speak with U.S. officials to keep the negotiations going, because ultimately this does seem to put a damper on what was seen as relative progress for the EU, considering they had moved up in line, was our understanding, after previous frustration from the White House. Now, if you asked the administration, 30% is lower than the 50% tariff threat that they were facing. But of course, it is still a very high number. And we heard from the German chancellor over the weekend, for example, who said that if a 30% tariff was enacted, Germany's economy, the largest economy in the European Union, would be hit to its core. That raises questions here about what sort of concessions could be on the table and what are those sticking points. Of course, we know that EU negotiators seem to be zeroing in on those sector-specific tariffs, particularly when it comes to autos. And we know that the U.S. has raised concerns about market access for U.S. agricultural goods. John, there is, of course, a range of issues here, particularly when it comes to the EU. But I'm going to put another quick one, another aspect to watch out for on your radar, which is how the administration often talks about defense spending coming in to these discussions. We heard from President Trump yesterday saying that the U.S. is preparing to send a Patriot missile battery, perhaps multiple. He said they haven't decided on a number, to Ukraine. We could get that announcement later today. But when asked who is going to pay for it, his answer was Europe.
Europe in focus, Brenda Murray. Let's sit on Europe. The response so far, cool, calm, collected, and the prospect of coordination between the European Union and other countries. What are we learning about that this morning?
Yeah, essentially, up until now, you had two options in dealing with the Trump administration. You could negotiate, and you were going to have to basically accept a deal that was unfair to you, a baseline 10% tariff or something higher, or you could retaliate. And we've seen no country really come back and retaliate. But this third option seems to be coming more and more into focus, and that is, what if we band together and we coordinate a response against the U.S.? We can't win the fight one-on-one with Donald Trump. He's always going to have more leverage than we do. But perhaps some of these countries, the Canada, the EU, some countries in Asia could come together and then put pressure on collectively. Now, we don't know what the details of any sort of coordination would be at this stage, but it sounds like there's growing acceptance that this third path is really the only way to stand up to President Trump and all these high reciprocal tariffs. The European Union said today that would essentially cut off transatlantic trade. So that's a non-starter for them. And talks that were looking pretty optimistic just a week or two ago look to be heading in the other direction now.
Hey, Brendan, appreciate the update alongside Tyler Kendall in London and Washington, respectively. Brendan went through the three choices here: negotiate, retaliate, coordinate. That third choice is something we're exploring this morning.
The idea that maybe countries are going to get together, creating a framework outside of the United States. They cannot replace the United States consumer, but there is this feeling maybe there needs to be stronger coordination. I'll just say, there was a real question about what kind of consensus there is there and just how much is going to be the Europeans absorbing some of the excess supply that still keeps getting exported out of China.
And we saw that today with the China trade numbers. What I find so interesting, though, this is counter what some Republicans actually want to see this administration do. And we heard that from his former vice president, Mike Pence. It's collectively find a fair trading balance with your partners and then isolate China, not the rest of the world working together to isolate the United States.
If you are just tuning in, welcome to the programme. I'm sure you heard all the threats over the weekend. Interested in how this market was going to open this Monday morning? Here it is. Equity futures down by about 1/3% on the S&P. Here's the view on Wall Street so far this morning. Tchir of Academy writing the following: while the market is right not to get too concerned at the moment, there is a risk that it's being very complacent. Pete joins us now for more. Pete, good morning.
Hey, good morning.
That risk always exists. Let's talk about whether the base case right now is justified or complacent.
I think it's heading towards complacent. I think the administration seems very comfortable with tariffs. They're coming out talking about them. Let's not forget, Trump, he really liked tariffs. And I think this whole taco thing is overdone. I think he pivoted, right? It wasn't going well. Stock market was coming down. He had other things to focus on. He pulled back. Now he's had a few big wins. I think the success that we had in Iran, very positive for him. Getting NATO to agree to 5% except for Spain, that was very positive for him. Getting the big, beautiful bill turned into an actual law was positive. I think he's going to take another cut at this. And the problem is, I think for markets, we're not going to get a quick reaction. We might not even get a reaction after August 1st, assuming the tariffs go in. Because last time the tariffs were actually in, I believe, for some number of hours before they pulled back. So I think this could drag on. I think it's going to be more of a slow bleed, unfortunately.
There's a larger question here. Is this just the market saying, look, we've been fooled before. What are you doing? We're not going to buy into these rates actually going through. Or is this a market saying, we've seen how companies absorb these tariffs, and it isn't going to be as big of a hit as many people initially thought?
I think it's the former. I think people are just like, we got fooled by this. We all got panicked. We all believed the Main Street versus Wall Street, the rhetoric that was coming out of the administration, that they would go forward. I think when you start seeing this, one, it's too early to expect much of a hit onto Wall Street, right? Even at 10%, one, companies had a lot of ability to pre-order stuff. That helped take care of it. You've seen a lot of USMCA goods get compliant, approved as USMCA compliant. That's reduced effective tariffs. And you look at the tariff revenue, I think it's about $80 billion over the last 3 months. That's a drop in the bucket in terms of inflation or anything. So I think we will not start seeing the inflation effects or the impact on corporate earnings until a few more months down the road.
Which is the reason why we've been talking about how pivotal this week is. How much are you concerned about it being a head fake if we don't see the real ramifications from tariffs, either in consumer inflation or in bank earnings in particular?
You know, I'm not as worried about the earnings. What I'm looking for a little bit is what are people seeing globally? What's the global economy looking like? We talk so much about the domestic economy. What's it like? What's spending going on? And are any of the U.S. brands seeing a pullback in spending? That, to me, is one thing. We've seen it in tourism. Is it more widespread? Because that would be a bigger concern to me, that you're starting to see this kind of pulling away from the American brands, which would be very consistent now with what you're reporting this morning, that other countries are trying to figure out, okay, what trade deals can we do away from the U.S.?
So what do you like then in this moment? If you don't think the president is just in negotiating mode and potentially some of these rates can stay?
So I still like anything that's really involved around national security, national production, right? And I think last week we saw MP, with ticker symbol, got an investment from the Department of Defense. It was a little bit ad hoc that the Department of Defense had that money, but maybe we start seeing the sovereign wealth funds, that we talked about at the start of the administration, start turning into something where you start seeing investment where the U.S. public actually gets to take advantage of the growth. We have to have rare earths and critical minerals, and not just the commodities, the processed and refined versions of those. We need chips, we need pharma. All those things, I think, that's where I want to focus, because the president could juggle two things, right? Push hard on tariffs on the one side, domestic growth, and those things do take away jobs from China. They bring jobs to the U.S., so they fit a lot of agendas. A lot of it's deregulation, which, again, is right up the president's alley. So that, to me, is a positive, that we last week in that investment by the Department of Defense is just the tip of the iceberg.
So you think the 50% tariffs on copper is good and it stays?
I don't know that it's good at all. Again, it's something we import a lot of, and we need to, and we're not going to be able to turn it back. But yeah, I think he stays. I think he tries to grow some domestic businesses around that. But it's going to come through investments, not going to come out through handouts or subsidies.
Quick final word on CPI tomorrow morning. We've had a string of softer than expected reads. Do we get a fifth tomorrow morning?
I don't think so. I think we've kind of bottomed out on it for a little while. I think there's been some pressure on, through some of what's been going on in the USMCA. I think people push some prices through. So I'm not alarmed, but I don't think we get a good number.
You're going to stick with us. Need some comments on Fed Chair Jay Powell and his future a little bit later in the programme. Peter Tchir of Academy there, sticking with us through the next segment. If you are just joining us, once again, equity futures, no drama here whatsoever, only down by 1/3% on the S&P. Expecting some action in the bond market. You're getting it in Japan, not stateside. Yields higher here in New York City by just a basis point across the long end of the curve. With an update on stories elsewhere this morning with your Bloomberg Brief, let's cross over to Yahara Arnold. Hey, Yahara.
Good morning, John. President Trump declaring a 30% tariff rate for Mexico and the EU. The new rates are set to take effect on August 1st. EU Commission President Ursula von der Leyen has responded saying they are working towards an agreement but are prepared to use countermeasures, while Mexico's economy minister called the new levies unjust. Meanwhile, President Trump and his allies are ramping up pressure on Fed Chair Jay Powell. In addition to criticizing Powell for not cutting rates, they're now focusing on his handling of the renovation of Fed headquarters. The Fed says the renovations are designed to reduce costs by consolidating its operations, but critics are focusing on what they call extravagant design features. And NVIDIA CEO Jensen Huang says the U.S. government doesn't need to worry about the Chinese military using U.S. technology. Huang told CNN that China will avoid the technology because it may be limited by the U.S. at any time. Chinese military adoption is one of the key concerns Washington has raised as it ramps up restrictions on chip exports. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later in the hour. Up next on the programme, a new line of attack on the Fed chair.
The bottom line is that this is the most expensive project in D.C. history, $2.5 billion with a $700 billion cost overrun. So the Fed has a lot to answer for.
We heard that on repeat over the weekend. Fed Chair Jay Powell's Fed very much in the crosshairs. That conversation up next, live from New York City this morning. Good morning. Equity futures doing okay, down by 0.3% on the S&P 500. The upgrades, the price targets keep coming. Lori Cavacina of RBC now looking for 62.50. That's up from 57.30. Follow similar moves from Bank of America, from Goldman, HSBC and Max Kender just last week. 2 words: buy more. The Nasdaq's down by about 1/3% at the moment, even with the additional tariff threats and this. Under surveillance this morning, a new line of attack on the Fed chair.
I think if Jerome Powell stepped down, it would be a great thing. We should have the lowest interest rate on earth, and we don't. He just refuses to do it, and yet he's spending $2.5 billion rebuilding the Fed.
It's the latest this morning. President Donald Trump and his allies zeroing in on Fed Chair Jay Powell's handling of the renovations of the Federal Reserve's headquarters. Administration officials building a case to possibly fire him.
The bottom line is that this is the most expensive project in D.C. history, $2.5 billion with a $700 billion cost overrun. To put that in perspective, the cost overrun for this Federal Reserve project is about the same size as the second biggest building overhaul in American history, which was the FBI building. And so the Fed has a lot to answer for.
Tchir, the Fed has a lot to answer for. Where's this one going?
I have no idea. It does feel politically that he's going to be under a lot of pressure in the coming days, weeks. You know, and I do think he probably should have cut rates or be on the pace. We should be cutting in July, I think. I don't like the jobs data. So I don't agree with all this policy, but I think pushing him out and this pressure, markets aren't going to like it. The world's not going to like it. So I don't love that strategy.
What do you think the cost is? What's the price of firing the Fed chair? I'm not saying it will happen. If it happens, what is the cost? And is it so high that it prevents it from happening?
You know, unfortunately, I don't think it's going to be that high. Front-end yields probably go down, right? Because whoever's going to come in is probably going to implement cutting. You see yields go higher maybe at the back end, but how much can 2s, 10s go out? So I think it's actually going to be a muted reaction. I think there's a lot of fear that we're going to blow up the Treasury market. I just don't think that happens right away.
And part of the reason why is because people say there's a whole committee full of Fed members that all have a vote. And yet Kevin Warsh, who previously was on the Fed Board of Governors, came out and said, we need regime change. We need an overhaul, and started talking about the strategic shift that he would like to see at the Federal Reserve. How realistic, how feasible is that?
You know, I've often wondered for the last, decade why we don't have more behavioral economists on the Fed, right? We have the traditional macroeconomists, and yet when you look at the Nobel Prizes, they're going out to the behavioral. So I think a shake-up and kind of some different thinking wouldn't be a bad idea. Again, I'm not sure that it should be done in this kind of, very quick and rough way. But I think there are things. How do we think about the world? How do people respond? I think a lot of traditional macroeconomics has failed us, and we've kind of missed the GFC. We missed European debt crisis. So bringing some new types of thinking might not be a bad idea.
There are two things that you're sort of alluding to here. And one is the fundamental economic justification for both a rate cut and a rethink of some of the economic modeling on the Fed. The other is the political jawboning that leaves people concerned about a Turkey situation, Erdogan-like pressure, talking about what happened with Arthur Burns that led to the highest pace of inflation that we've seen in modern history in the United States. So how do you distinguish between the two? And does this kind of pressure make it less likely that they can cut in a way that might be appropriate economically?
So I would have said before this weekend, I felt they would be pressured not to cut because they didn't want to be bowing to this. But it does seem like this is a whole new line of attack. They're kind of going down different avenues to get that sort of change. And if that happens, then I think we do get cuts very quickly, because whoever comes in will try and say, well, this has to be our mandate. It's probably the most confusing I've ever had, because we've never, I think, had to figure out the political ramifications of the Fed in such a way.
Kevin Hassett was asked about this over the weekend. He says they're being looked into, whether or not, if there's cause, he could be fired. But this would be about issues regarding renovations at the Fed. Does it matter to the markets what the potential issue is that they think they have a legal standing to fire the Fed chair?
I think it does make a difference. And I do think one thing, Powell was very successful independently before he joined the Fed. So I think he probably has a lot more stomach to fight this than someone who didn't have, his own personal wealth, isn't coming into this job very strong. I think he is very committed to what he's doing. So, I find he will not go down easily.
If he's not going to go down easily, then do you think he sticks around to finish out his governorship to 2028?
I think that's such a long way away in this environment right now. It's like we have trouble living week to week.
Right, but he won't tell Trump administration officials, he won't tell reporters. He's repeatedly asked about this and doesn't give an answer.
I think there's no reason for him to give an answer. Why make it easy on anyone? It's his kind of a little bit of leverage. Maybe it's what makes him happy when he's, fighting with this. So I feel it's all a bit of a sideshow to what we should be looking at, and that's not good.
The price of this. Now, you said it wouldn't be that high. George Saravello said it's 30 to 40 basis points in a fixed income sell-off in the following 24 hours. For the FX market, it could mean a 3 to 4% move in the trade-weighted dollar. Lisa brought up the experience in Turkey. If you go back to spring of 2021, when Erdogan fired his then central bank governor, I think the following day we had an 8% move on the Turkish lira. Are you not expecting anything like that in the following 24 hours?
I think it'll be hard. Like, you want to sell off. I think that I agree on the FX. I think it's going to push people away from the dollar. I think that makes sense to me. But why would T-bills sell off a lot, right? Clearly, you're going to get someone coming in, and I think that will anchor the curve a little bit. I think maybe you get this
initial... anchor the front end. Tell me what happens further out along the curve. I'm not interested in the front end. I want to know what happens to 10s and 30s.
Maybe it widens a little bit. I don't see a 30 to 40 bip. I would not be surprised to see markets actually remain more calm than all the hype, unfortunately. Well, I think that gives the whole ammunition, but I think there's just so much more going on than the Fed chair. Now, if we believe that someone's going to come in and cut 100 bips immediately and get us down to 2%, that's a different story. But I think if you think someone's going to cut 50 and try and get down 100 bips by, September, do we really sell off that much? That's kind of more in the ballpark what I think the Fed should be doing anyway, so I'm not going to react that negatively.
Are we setting, though, a precedent that becomes dangerous for the bond market going forward? And I say this not just from the U.S. perspective, but globally, at a time when you see all of the long bonds around the world in developed markets selling off in the prospect of more spending and politicians that don't want to have to raise taxes or cut spending in order to reduce the deficit. Isn't this a fundamental problem that increasingly politicians will just jawbone their central banks as opposed to actually taking the pain?
Yeah, and I think it's like a lot of things. We've had executive orders skyrocket over the last 20 years. Everything's kind of being done a little bit backdoor, maybe not quite by the official channels. So I think those are all risks. One thing I keep, we've been arguing to our customers probably for 3 years now. You're supposed to be, if you're investing in 1 year and in paper, heavily overweighted towards corporate debt, commercial paper, because corporations actually have good governance, right? Corporations that are there to make sure their bills are paid on time. So I would be overweight. I think you're getting that extra spread, and I think there's going to be more and more conversation about what should one of these top companies trade versus the U.S. dollar, versus T-bills. I don't think we're trade through. I don't think we're there at this point, but I could see us approaching that. Right? It's happened in some, third world or EM countries in the past for a variety of reasons. We're not there, but I think you're getting free spread almost when you look at some of these AA, AAA, even single A companies who are issuing commercial paper. I would own that all day long instead of T-bills. I think it's less hassle.
Peter, if you don't think there's going to be a massive implication to the markets if they fire Fed Chair Jay Powell, what's holding them back then from doing it?
I assume there's legalities in how to do it, whether they're allowed to do it, and I'm sure that's being worked on. Pete,
it's good to see you, as always. Thanks for dropping by. Peter Tchir there of Academy on a big situation with the Federal Reserve, potentially, and the latest tariff threats. Just on the Federal Reserve, Pete kind of alluded to this. What's important here, of course, not just whether he's fired or not, who replaces him. If it would be someone super credible inside the FOMC, say a Governor Waller, for instance, maybe there would be a level of comfort there. Perhaps we should acknowledge. But I have to say, the base case, the overwhelming consensus for you right now, if you get rid of the Fed chair, you'd see some fireworks in financial markets.
Especially given the fact that you have auditioning going on right now and people are trying to out-hawk each other with respect to how quickly they're going to fire Chair Powell and out-dove each other with how much they would cut rates and potentially replace other Fed members. I mean, I thought that was really notable. Kevin Warsh amping up his rhetoric maybe to get the front seat when it comes to replacing Jay Powell.
Well, the two Kevins first in line to replace him are the ones who were piling on the pressure over the weekend.
And it's as if one of them was trying to one-up the other one in terms of, he is making a Versailles, as we were just talking about, and the potential for replacing other Fed members, really raising the pressure significantly.
Certainly not the base case this morning, with futures down by about 1/3 on the S&P. Up next on the programme, we'll catch up with the former senior White House trade advisor, Kellyanne Shaw, on President Trump's latest tariff threats. Plus, Yahira Anand with your morning movers. Kraft Heinz shares rising as the company weighs a breakup. That stock is up by 1.7%. From New York, you're watching Bloomberg TV. Where did the weekend go? Trump time. Weekends just don't seem to happen, do they? Equity futures right now in the S&P, negative by a third of 1%. We're down by a similar amount on the Nasdaq 100. Just missed out on a third week of gains on the S&P 500 last week, going into a big one in the next 24 hours. CPI just around the corner and lots of bank earnings for you. With 3 hours until the opening bell, let's get you some morning movers with Yahara Anand. Hey, Yahara.
Good morning, John. We start with Kraft Heinz. Shares are up 1.7%, adding to Friday's gains after reports surfaced that the food giant is preparing to break itself up. The packaged food company is said to be weighing a spinoff of its grocery business in order for it to focus on other faster growing areas like its sauces. We've talked a lot about deals or possible deals in the packaged food space lately. We had Ferro buying WK Kellanova last week, so this is the next big one to watch. Meanwhile, we take a look at crypto-linked stocks, all rising, riding Bitcoin's latest move higher. MicroStrategy and Coinbase are among the stocks getting a bid here as Bitcoin soars to record highs, breaching $122,000 this morning. This is coming as the U.S. House of Representatives gears up for what it's calling Crypto Week, where it plans to take on legislation in crypto. And last up, we end on the automakers. They are all weaker this morning on fresh tariff uncertainty by President Trump. But I want to highlight General Motors, which is down 1.6%. It confirmed a Reuters report that it's pausing production for weeks at one of its key plants in Mexico that sells its top-selling Silverado and Sierra trucks. And while it's normal for automakers to halt work at factories due to maintenance, Reuters does point out that weeks of downtime at a key plant like this one is unusual. John?
Yahara, thank you. A little bit more from Yahara later on this hour in about 15 minutes or so. On our radar this morning, our top story, President Donald Trump announcing a 30% tariff on goods from the EU and Mexico, set to take effect on August 1st. Trump then saying if the countries retaliate with higher tariffs, he'll add another 30%.
And this should come as a shock to people, given the fact that he had talked about potentially getting a deal done with the European Union. There had been much better mood music around Mexico. It raises a question, is this just trying to ramp up some of the pressure to get a better deal? Is this the actual rate? And when will the market wake up to this? Or has it already, given the fact that you haven't seen the ramifications and profit margin contraction yet, or necessarily in the CPI prints?
The NEC director, Kevin Hassett, basically signaled that at this moment they are negotiating. Even in the president's own letter, he said, if you open up your markets, we will then amend the tariff rate. With the European Union, my head is spinning. 20% April 2nd, ratchet up to 50%. Now we're back to 30%. In the middle of them having negotiations, what they say every single day. What I think is more interesting about this story right now coming out of Brussels is the other capitals they're calling to try to get other trading partners in line with them to then go to the White House, Japan, Canada, others in Southeast Asia to say we should approach Washington together as a collective group.
I want to live in Ed Bastian's world over at Delta Airlines where things are stable and everyone has clarity to invest in the future. That's a very interesting world he's living in.
Well, you should go to the C-suite because they cannot survive on headline roulette. And that's what you're seeing. A lot of them are just taking a pretty steady look. Consumers are still spending. And you know what the truth is? We're all a little exhausted from headline roulette. And so a lot of consumers are saying, we got to look past it and live our lives. Let's go on vacation. The kids are off school. So, we'll deal with all this stuff later. And I do think there is an element of exhaustion. What was it that you said a couple weeks ago? Is this the strategy? Just exhaust your trading partners until they're like, whatever. You want that?
I'll take the 10-15%. Yeah. Let's move on. I think it was Kellyanne Shaw last week who said, grab a beer. Yeah. Ignore the next 2 weeks.
Amen.
She's going to join us in about 5 minutes' time. Hopefully hasn't been drinking beers this morning. We'll come back to that in a moment. President Trump ramping up criticism of Fed Chair Jay Powell, saying he hopes Powell should quit his role. Trump is joined by the NEC director, Kevin Hassett, and the former Fed governor, Kevin Walsh, in calling for change. It was the two Kevins. It was the vice president of the United States. It came from all corners over the weekend.
In this Alice in Wonderland land, a lot of people are wondering what the political implications of this are. Is it just the Kevins auditioning? Is this Trump trying to set up a fantastic scapegoat? Is this trying to pressure the Fed to cut rates more significantly? Or is this a serious look by the administration to truly oust the head of the Fed at a time when they have been highly critical of the unwillingness to cut rates? Look, I don't know that the market is really taking this as reality. Because right now, I agree with you, John, and I agree with George Saravelos. It does seem like there would be a much more significant reaction in the dollar and in the long end of the yield curve, akin to what we saw last year.
Well, what's the reaction, even if they put someone in place, if the market doesn't seem credible? And Jonathan, you've been asking this question every single day. Neil Dutta over the weekend said, for all the talk of shadow Fed chair, if either Hassett or Warsh get the nod at the rate they are going, they may well end up being a, quote, chairman in name only. So basically, not sure of all of this public auditioning to the extreme is potentially going to help them if they were to get jobs.
Given the threats over the weekend, not seeing much price action whatsoever stateside. Yields are higher by a basis point or two. If you want to see a big move in the bond market, check out Japan. Overnight, global debt markets very much on alert given developments in the Japanese debt market. Yields higher across the curve there, on the 30-year up by some 11 basis points. Going into this election in the next few weeks, the real risk of more spending and higher bond yields.
Look, this is the uncomfortable truth, and it's happening around the globe. It is that politicians do not want to cut spending, and they do not want to increase taxes. And right now, the political party that is winning in Japan is one that is promising more spending while not necessarily increasing taxes, in fact, by cutting taxes. And this is really a question that is increasingly relevant given that President Trump is pushing a lot of the trade partners to increase spending on defense, to increase infrastructure spending of their own. So all of a sudden they have to borrow more. And nobody wants to say, we're going to take something away from you. And that is what the bond market is getting nervous about.
The fact is coming out of Japan makes everyone that more nervous. We've had 25 years of this being a dominant anchor around the neck of the global debt market, holding yields lower. That's being released in a way we haven't seen for a long time.
So does this set the bar a lot higher? It's notable that U.S. long yields are not rising that much. They're not rising nearly as much as what you're seeing in Germany with a similar type of dynamic. It just goes to underscore a bond market getting yippy is not just a U.S. issue. And whether it continues with yields permanently at a higher pace as collectively, the market is dealing with a lot of debt from developed markets and really not a plan to pay it back.
No yips in the Treasury market, at least so far this morning. Let's turn back to trade. The EU stepping up engagement with countries hit by US tariffs following President Donald Trump's announcement of 30% levy set to begin on August 1st. The former senior White House trade advisor Kellyanne Shaw writing, the president believes he still has a long leash when it comes to tariffs. For countries that don't have deals by August 1st, I do expect tariffs to go up. Kellyanne joins us now for more. Kellyanne, welcome back to the programme. I think you told us all to get a beer and take a break last time, and then everyone gets fired up after the announcements over the weekend. How seriously are you taking some of the threats this past weekend?
Yeah, good morning. And I think I have the same advice today that I had last week in that, you know, this is not for us. This is not for business. These tactics are really for other governments. And I think that Director Hassett said it well on Sunday when he said the president was trying to squeeze every last drop out of some of these deals. So that to me is really what these letters are about. You know, I'm still relatively optimistic we'll land somewhere with the European Union. The Mexico letter was a bit of a surprise to me, given that they weren't negotiating one of these full reciprocal deals. It was really about steel and aluminum. But that said, we've got 2.5 weeks to go, and I expect to see a bunch of deals. And for those countries that don't have them, I expect to see those tariff rates go up.
When you say you do think this is the president trying to squeeze every last ounce out of these trade negotiations, say it comes to the European Union, what is he after?
Well, with the European Union, there are a number of sticking points. And I think everyone's expectation is that if the U.S. and EU were going to be in a position to agree, that it would be to basically a subset of issues and not every irritant. But I had been hearing some consternation about agriculture in particular and some frustration on the U.S. side that the EU wasn't willing to cut some of the more sensitive tariff rates. And then a lot of disagreement over those Section 232 carve-outs and what those might look like on autos, steel, pharma, semiconductors. And then, of course, the president has long talked about Europe's treatment of U.S. tech firms and from state aid to the DMA and DSA. And so those are going to continue to be difficult points between the U.S. and the European Union.
The European Union, we have a story, is preparing to step up engagement with other countries, potentially approach the United States with other allies. Do you think that tactic could work with this administration?
I think it is a unique administration who negotiates in ways that are not typical in terms of diplomatic relations. So why not? Why not come to the United States as a bloc and say, here is a potential solution and a potential way forward? Because what is clear from President Trump's tactic in terms of taking the sledgehammer to the global trading system and negotiating bilaterally with every government on earth is that the current global trading system, the World Trade Organization that has 166 member countries, just doesn't work. And so if there are a subset of countries who want to join together and approach the United States, I think the administration could be open to that.
Kellyanne, you said a key word there, tactic. And this is what the market is viewing all of this as, at least in terms of the muted reaction that we're seeing this morning, a tactic to negotiate a better deal. Is this negotiating with the trade partners, or is this negotiating with the market?
I think it's predominantly negotiating with the trading partners, but I do think that the market is playing a role. And right now, the fact that the market hasn't reacted as significantly as it did in the aftermath of April 2nd, coupled with low inflation, positive job reports, and overall good economic indicators, I think does embolden the president and gives him a longer leash on his tariff strategy. Now, if the markets were to totally go the other way, I do think that that might have a bit of a mitigating impact on some of these tariffs. But I think the market is reading the situation exactly right, which is the president is sending these letters out, announcing these high tariff rates in the hopes of actually getting deals so that he won't have to impose those tariffs.
So, Kellyanne, that's where I think there is some confusion. What is the tariff strategy? Is it to get deals that are specific and have certain parameters, or is it just to see how far someone can push before you get revenues on the tariff side and markets don't freak out?
Yeah, I think it can be a little bit of both. I mean, certainly the pressing task right now is to create this action-forcing event that by August 1st, these tariff rates will be exceptionally high unless countries are able to get a deal. I think that's really first and foremost on the president's mind. But the second line of messaging that we're hearing is about this revenue and the fact that the tariffs have been good for the U.S. economy, that prices haven't gone up, and we're going to use it to pay for some of these tax cuts. I think that's about softening the message on tariffs so that for countries that don't get deals, it's not viewed as catastrophic, the sky is falling, that there might be some positive benefit there. But I do think at the end of the day, it would be best case scenario for everyone involved to find some sort of landing zone in terms of these bilateral negotiations with countries and to see a bunch of deals get inked and see those tariff and non-tariff barriers come down.
Kellyanne, appreciate the update, the catch-up. Thank you. The former senior White House trade advisor, Kellyanne Shaw, there on the latest. Just to build on what Kellyanne was saying, it's not just the market giving them the green light at the moment. So far, and I stress so far, things can change, but it's the economy as well. The economy hasn't changed too much in the past few months.
Which is the reason why this is a pivotal week. We get the latest read, and people say that in the June CPI and PPI, we'll have a better sense of just how much those tariffs did cause prices to go up. And you've got earnings, so you can see how much that hit corporate profits. Right now, they might have a green light. Going forward, I think the key question is people might agree with the ultimate goal, but the strategy that's being used leaves people trying to understand what the framework is because it keeps shifting.
That last point, though, from Kellyanne Shaw really shows the branding of this administration. If they get a deal, great. They can have a Rose Garden or Oval Office event like they had with the United Kingdom, and I was there for that one. If they don't, then they come out and say, well, look at all the revenue we're bringing in, and this is going to help bring down our deficit and offset the tax and spending bill that we just got through Congress.
And there's a lot of revenue coming in. Let's be clear about that. In the bond market at the moment, yields are a little bit higher at the long end of the curve by a basis point or two, and the equity market down by only 1/3% on the S&P. With an update on stories elsewhere, with your Bloomberg brief, here's Hauer Anand. Hey, Hauer.
Hi, John. President Trump says the U.S. will send more Patriot air defense batteries to Ukraine. Kyiv has said it needs the aid to protect itself from Russian airstrikes. The move comes before Trump is expected to make what he's calling a major statement on Russia later today. Meanwhile, former President Joe Biden is pushing back on President Trump's claims about his mental acuity while he was in office. In an interview with the New York Times, Biden said he made all the clemency decisions that were recorded with an auto pen and that he orally granted all pardons and commutations issued at the end of his term. Now on to the latest on the flood disaster in Texas. The search for victims is expected to resume today along the Guadalupe River after recovery efforts had to be put on hold yesterday after another round of heavy rains. More than 160 people may still be missing after the July 4th floods that left at least 132 people dead. That's your Bloomberg Brief. John?
Tragic. Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the programme, bracing for tariff impact.
The president is getting the message loud and clear. The economy can absorb a lot of these high tariff levels without a huge downturn, and I think that means he's going to keep going.
Joining us next, Leo Feler of Numerator, live from New York City. This is Bloomberg. A lot of threats over the weekend on two fronts, trade and central bank independence, and this market doesn't blink. Equity futures on the S&P down by 1/3%, on the Nasdaq 100 down by a similar amount. Under surveillance this morning, we're bracing for tariff impact.
The president is getting the message loud and clear. The economy can absorb a lot of these high tariff levels without a huge downturn, and I think that means he's going to keep going. They're working in that the president can put them in place without any negative consequences, and the economy is doing great. This is a rebalancing of stuff that was broken in the U.S. economy for decades.
So here's the latest this morning. Investors are waiting inflation data for a read on how tariffs are impacting the economy. Leo Feler of Numerator, a research firm focused on the consumer, writes the following. We still don't expect to see much of an effect of tariffs in the CPI. This doesn't mean that we're in the all clear. Leo joins us now for more. Leo, good morning.
Thanks so much for having me.
We've had 4 softer than expected prints. 4 in a row, a nice string, a nice run of things. And a lot of people came on the programme and said, this is not signal, this is noise. Wait until the summer. Summer's arrived. Does it change?
I think it will start changing, but very, very, very slowly, right? One of the things that we saw coming out of the pandemic inflation starting in 2021 is that it took about 14 to 16 months for inflation to peak between when consumers went out and started spending all their pent-up savings, after we had the mass vaccinations, until we got peak inflation. 14 to 16 months is a long time, right? We're only about 3.5 months out of the initial tariff announcements that were then paused, right? It's still too early for us to really to start to see a wave of inflation. We might start to see a small trickle of inflation showing up in the data.
If that's the appropriate time frame to think about things, just describe through an industry, a sector, how this could cascade through the economy in the next 18 months.
Yeah, so one of the reasons that we haven't seen the tariff impact yet is that a lot of manufacturers have contracts with their suppliers, right? So their suppliers can't pass on higher aluminum prices quite yet, right? They're locked in, or they have hedges that protect them from these higher input costs, right? Then a lot of the suppliers have contracts, or manufacturers have contracts with retailers that prevent them from passing on prices to retailers. Once these contracts start resetting, right, which takes about 6 months, then we should start seeing higher inflation prints in the CPI. And the last thing to keep in mind is that one of the CEOs that I spoke with said we have one bite at the apple, right? We can't walk into a retailer and say we are increasing prices, right, by 10% or 20%, and then a few weeks later say, oh, never mind, right? Tariffs aren't as high as we thought they were going to be. We're going to, raise it by something else. Oh, never mind, they're now actually much higher. We're going to raise it by something else, right? And so it takes time for all of this to first develop more certainty, right, and then for suppliers, manufacturers, and retailers to start reacting and passing on these prices to consumers.
The chain of events that you're describing is incredibly important to hear because there are some people saying you're either going to see it in CPI or you're going to see it in consumer in company earnings. You're going to see it in profit margins getting compressed. What you're pointing to is something else. There is a lot of other venues that are offloading some of the tariffs for now, but that potentially will not be there going forward. Can you talk about what % of the tariffs are getting offloaded by just contracts that are forcing it onto suppliers that aren't going to take it once those contracts are up?
Yeah, I think it's most of the tariffs right now are actually being absorbed by suppliers, right, and not being passed on because they're simply locked into contracts that don't allow that to happen, right? And the other piece is that a lot of suppliers built up inventory in anticipation. We're seeing this with copper right now, right? With suppliers front loading a lot of the supply of copper that they might need going forward. And so this is one of the reasons that I think almost none of this has really had a reason to be passed on to manufacturers and then on to consumers, because it's in such early stages that it's not overall impacting even profit margins yet for manufacturers.
One argument for why this won't be quite as inflationary as some people expect is from consumer pushback. They're sick of getting tariffed. They're sick of, not necessarily tariffed, they're sick of inflation going up and really, eating into their real incomes. Do you think that they have more capacity to absorb price increases than many people believe?
You're absolutely right. So this is very different than coming out of the pandemic, right? Coming out of the pandemic, there was so much pent-up savings, right? There was so much pent-up demand that consumers basically shrugged off the higher prices and went out and started spending anyway. And that's gone, right? There is no excess pent-up savings that exists today for consumers to use as a buffer. So consumers are actually being a lot more discerning. And we're seeing this with a greater focus on private label items, right? Shifting towards lower cost retailers. We're also seeing it in consumers doing a lot more research, right? We just came out of Amazon Prime Day. And one of the things that we saw in the Numerator data is that, even for things like paper plates, consumers were looking at Amazon, but they were also looking at Walmart and Target to see where they could get better prices for paper plates, right? Like, this actually takes a lot of time for consumers to be able to research where to get the best prices. And the fact that consumers are actually using this time, right, putting in the investment to figure out how to save a marginal dollar here or there, just signals that companies are not going to have the pricing power that they had coming out of the pandemic.
But at the moment, they are still spending. And you say when it comes to retailers or any sort of company, they're waiting to take that one bite out of the apple. How do they decide when to sink their teeth in?
I think this is a really difficult, question, because first they're going to be timed into contracts, right? And so they have to take it when there's a moment that they have a window to renegotiate with or to negotiate with their retail partners. And then they're waiting for more clarity, right? What is the final tariff? Now, one of the things that I've heard from one of the companies that I work with is that they have set tariff pricing triggers into their contracts, right? So since they don't know what tariffs are going to be, they have various scenarios with their retail partner that says, look, if tariffs are X, we are going to raise prices by this amount. If tariffs are Y, we're going to raise prices by this other amount. And that's already baked into a contract. It's going to be, right, for, September onwards. And so it even should not show up yet, at this point in the data.
Well, April 2nd became July 9th, becoming August 1st. This timeline can be extended. We don't know how long. Right. But many people think Trump can be in negotiating mode for more than just 2.5 weeks.
But the tariffs are already hitting, right? So we're now at a 15% effective tariff rate. And if you look at this year so far relative to last year, we've collected about $50 billion more in tariff revenue. If that were to be passed on to consumers, which it hasn't yet, right, that would be another $400 or so per household that they're spending so far this year, right? Not an astronomical amount yet, right? Estimates from Yale Budget Labs say that if this is going to get passed on to consumers, it might be an extra $4,000 or so, per year that consumers are paying in higher prices for consumer products, right? It hasn't really started showing up in a way that would really suggest the consumer is truly feeling this. But I expect that to start happening once we get into back to school season and probably Christmas.
One missing piece in this whole conversation, just a final question from me. How much success are the companies that you speak to, how much success are they having putting the pressure on the exporter to drop prices?
The exporter has barely dropped prices because we can actually look at the data and look at the prices before tariffs are implemented. And those price levels are the highest that they have been, right? So we're not seeing this come down at all. And part of that might also be, right, maybe they are reducing prices a little bit, but don't forget, the dollar has lost about 10% of its value, right? And so even if they've dropped their prices by effectively 10%, the rising, the decline of the dollar means that import prices are about 10% higher. On top of that, you're adding tariffs, right? So this is a really, the effective tariff rate at 15%, plus a 10% decline roughly in the value of the dollar means that we should expect about 25% higher import prices.
The FX move has compounded the problem. We've seen that all year.
And frankly, some people will say that it'll be felt in the CPI coming up on Tuesday.
Leo, this was great. It's good to see you. Thoughtful stuff. Thank you. Thank you very much. Leo Feler there of Numerator. Up next on the programme, Tom Becker of BlackRock, Henrietta Treyz of Veda Partners, Vito Sperduto of RBC Capital Markets, and John Lovallo of UBS. From New York, the second hour of Bloomberg Surveillance. Up next.
The president is getting the message loud and clear. The economy can absorb a lot of these high tariff levels without a huge downturn.
The U.S. economy is likely somewhat bigger than policy until you get to a certain level.
We'll see the low-end consumer continue to remain fairly sluggish, but the rest of the economy should be okay.
You've got a little bit of a disconnect, and it's kind of a tale of two cities.
You have the ability to adjust quicker than people think. And this is really what sets the U.S. economy largely apart.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. Good morning. For our audience worldwide, your second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Equity futures on the S&P 500 negative only slightly by a third of 1%. On the Nasdaq 100 down by a 0.3% also, and a similar move on the Russell 2000. Following a weekend full of threats, this market still isn't blinking and going into a week full of event risk. We've got bank earnings on deck and CPI tomorrow morning.
This is a market hoping for a compass at a time when some of the policy discussions have felt a little bit, I don't want to say rudderless, but lack of clarity has certainly been a theme. This week we'll get maybe a little bit more clarity, although that will be debatable in terms of what type of solidification we get in CPI, how much consumer prices do go up on the heels of tariffs, and then how much companies are absorbing it, or can they just keep adjusting and adapting and moving forward the way that a lot of people are pricing in.
Never mind companies, how are countries going to respond to all of this? Over the weekend, a threat of a 30% tariff on the EU. You've got three choices. You can negotiate, you can retaliate, or you can coordinate with trade partners. An extra lane being added over the weekend.
Yeah, over the weekend, what we heard is this potentially third scenario that Brussels is working out, having some calls maybe with Japan, Canada, India, trying to coalesce with other trading partners to then confront the United States as a more united front. Will this work is the key question, especially when you have the Treasury Secretary going over to Japan at the end of the week and the president himself and his team in negotiations with some of these other countries like Mexico. Their economy minister basically is back and forth between Mexico City and Washington. But it also could be used from Brussels as a threat. Look, if you're not going to lower the rate from now, it's 30%, went to 20 to 50 to 30, then potentially we are going to do our best to go after all these other capitals and try to make your life more difficult.
Lots of trade threats, we're ignoring them. Lots of threats on Chairman Powell, we're ignoring them. That was seriously a full court press over the weekend. Kevin Walsh, Kevin Hassett, the Vice President of the United States, putting the pressure on the Fed chair.
And shifting the tone of exactly how they were going to fire him, painting a path to actually have the legal standing to do so for cause because of renovations that they say were excessive. They went up when they initially started. The estimates went from $1.9 billion to currently $2.4 billion. There has been an increase. There's a big back and forth. A real question here. It depends who they put in Jay Powell's seat and whether they touch the composition of the rest of the Fed seats. Can they do that? Can Congress push back? French Hill, a Republican from Arkansas, over the weekend said, look, this is Congress's job. We're going to have more strict oversight, but they don't have the power to do this.
Bond yields higher by a basis point on a 10-year. You'd have no idea any of this was going on. On a 30-year, up by 2 basis points. The fireworks are in Japan once again. We've got to track that story. The Japanese government bond market kind of breaking down. Very slowly, but breaking down.
Yeah, you're seeing the 30-year yield close to 3.2%, the record high, as you have politicians saying we need to cut taxes, increase spending, and they are actually getting the running seat. They are being increasingly popular as a result. This goes to an existential question. Where is the anchor going to be in the global developed market bond market at a time where everyone has caught the wind of what the U.S. strategy has been? Borrow, 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 spend, 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 and never take the medicine that's required to actually pay your bills.
Well, it's not the U.S. right now, and it's certainly not Japan. That's for sure. More on the bond market in just a moment. Coming up, we'll catch up with Tom Becker of BlackRock, looking for a strong CPI print tomorrow morning. Henrietta Treyz of Veda Partners as President Trump slaps a 30% tariff on Mexico and the EU. And John Lovallo of UBS on the potential for a housing recovery in 2026. We begin this hour with stocks down on President Trump's latest tariff threats. Tom Becker of BlackRock writing, our read of the data is that we'll get a stronger month-over-month CPI read on Tuesday. This earnings season is an opportune time for the companies to provide guidance on how and when tariff costs will be passed through to consumer prices. Tom joins us now for more. Tom, welcome to the programme. Let's start with that first line. Why are you and the team expecting a pickup in inflation as soon as tomorrow?
Morning, John. Good to see you. I think we've had a couple months here, a quarter of weaker CPI prints. And from our take, that's been related to companies not really knowing what the effective tariff rate is, not wanting to antagonize consumers, not really wanting to potentially lose market share and step out ahead of their competitors, where others are maybe a little bit more cautious with raising prices. And as your last guest said, consumers are pretty savvy. Inflation expectations and behavioral changes around inflation are embedded into behavior now, and I think companies are aware of that. We think with the increasing certainty that companies have about some of the effective tariff rates, we think some of the pass-through is going to start happening in this June CPI this week.
Tom, let's say you're right and inflation firms up through the summer. Is it the kind of inflation you can look through, or the kind of inflation that you should expect to hang around and maybe continue to pick up?
From a policy setter's perspective, this is the worst kind of sequencing you can imagine, because you're having these deals negotiate over the course of months and quarters, which looks like a slow bleed in of inflation into the economy rather than 1 month, one and done. When the tariffs first came up, we were thinking about this as like a VAT hike as a framework to kind of think about how this might affect the economy. So it's a tax hike. It's on consumers. It's on a subset of the things that they consume. But it's seeming more like it's going to be a more continuous bleed into the data. And so that's trickier for policymakers to say, come next June or July, oh, the tariffs are no longer in the data. We think it's going to be much more of a gradual process, keeping prices closer to 3-4% for a while here.
You know, for the past couple of months, everyone kept saying that the United States will bear the brunt of all of these tariffs in terms of slower economic growth. Are we rethinking that now, especially as other countries are being forced to spend and borrow at a faster pace?
Good question. I think there are three potential parties that can pay the tariffs. You can have exporters pay the tariffs. You can have U.S. consumers pay the tariffs. But the actual parties that have been paying the tariffs thus far are U.S. corporates. So last month, tariff revenue in the U.S. over $27 billion, $20 billion more than a year ago. That's $20 billion that somebody's paying. And if it's not in consumer prices, it's been much more on margins. And so I think, the quote you brought up at the beginning, just thinking through how companies are going to explain to shareholders, how are you going to navigate these prices? How are you going to keep margins? I think the U.S. is uniquely in that position of having to think through which parties bear the tariffs. And to date, it's been companies. We think more of that's going to shift over to consumers.
Do you think, though, that it's companies just in the United States, or do you think that there has been a sort of overly sanguine attitude by investors toward how much of a hit German companies are going to take, Japanese companies are going to take, and just around the world?
I think if you look at share price performance here today, Lisa, it seems that people have been sanguine about the demand hit, and you've had foreign companies outpace U.S. We've been positioned for more U.S. equity performance here in the summer in this earnings period. We think it's set up a little bit better. I think there is, there's been a rating, a multiple re-rating in foreign companies year to date. They're going to need to start showing some earnings. And if you think about the medium-term incentives here, tariffs aren't going away. You're seeing CapEx intentions and sourcing intentions move. I think your previous guest talked a lot about kind of how this is embedded into the system, and I think that's the right way to think about it here. But as you're thinking about multiple years of tariffs, I think these slower-moving decisions of do I source my products from abroad, like currently potentially, or shift more of that to the U.S., I think that's a very plausible outcome is you're going to get more domestic production, more activity in the U.S. over time.
Tom, tariffs aren't going away, and the president almost seems emboldened now. We're seeing some rates that are higher for some countries than they were on April 2nd. But after April 2nd, we saw a reaction in the market. Do you think the market at some point will start to push back?
So I think on the bond market, it's been a pretty range-bound year and pretty interesting to think about what some of the catalysts have been for some of the shifts in the range. You were just talking about the 30-year Japanese government bond moving up, but Friday's move in the U.S. was pretty big. I'm not really sure if it was that the market got around to reading Governor Waller's speech on Thursday, which talked about having a much lower duration balance sheet. But you've had these yins and yangs of kind of shifting the market winds. Initially, it was fears of inflation, and then the market got okay with some of the inflation prints and thinking maybe tariffs weren't going to be so bad. We think it's more of a delay here on kind of the bond market, recognizing if the economy's okay, which I think the data has definitely borne out the last couple of months in terms of activity, and you start to get inflation here, are these fair levels of yields to compensate investors for maybe the Fed not having to cut this year, and then the long end having to deal with all the issuance and the supply and the inflation risk kind of continuing for a couple of years here.
Tom, we saw equity markets do well following the pandemic with a pickup in inflation. Nominal growth exploded. Tom, I wonder from your perspective whether you'd expect something similar or if it's slightly different this time, and in what way?
I think in terms of getting exposure to a nominal, like you said, John, a nominal asset, equities are great, particularly to the extent that they can kind of keep margins high and pass some of these costs on to consumers. I think we are, the global economy, we think is in this kind of swim lane of higher nominal growth than it was in the previous decade. So we think that's continuing. We think it's broadening this year. Equities are a great asset to capture kind of that expansion. There's a bit of a TINA element potentially here where people look, they're like, bond yields, do I really lock in 4% with inflation heading above 3 again? Or do I lever myself again to kind of the asset that's going to give me exposure to that growth? And also companies have been super nimble about dealing with these tariffs. There was a news last week about Delta moving engines like across borders.
Yeah.
I wouldn't underestimate the ability of U.S. corporates to navigate these and find ways to kind of deliver shareholder value back.
Tom, what you're saying, though, I think is important. Just a final question. There is an underlying assumption here, and that it's the traditional inverse correlation between stocks and bonds reasserting itself. How convinced are other people by that idea, given the dynamics we've seen over the past few months?
So across the BlackRock platform, we're seeing less and less of a conviction that we're headed back to that negative stock-bond correlation. We're seeing lots of flows into diversifying liquid alternatives that are navigating kind of these equity blips a little bit better than bonds. And I think part of the reason why that positive correlation between stocks and bonds has been so sticky and persistent is it's related to kind of this inflation risk, the institutional risk. Historically, that's when you see that correlation shift to be more positive. And I don't think anyone thinks we're going back to kind of a QE ZIRP type environment, which is kind of the ideal environment for that diversification from fixed income. So broadly, we're seeing kind of investors, shift assets to speak to that kind of higher correlation between those two assets, which means it's harder to find diversification in your portfolios. And that's what investors really want to find these days.
Tom, thank you, sir. Appreciate it. Tom Becker there of BlackRock, giving us plenty to think about. Might also speak to some of the moves we've seen in gold and in Bitcoin over the past year.
You raise a really important point, which is what is the counter-cyclical response of bond markets at a time where a lot of governments have already been borrowing a lot of money? Can they borrow more to have a fiscal response to that negative growth shock, that whatever it might be when it comes down the pike? And if they can't, what does that do to bond yields and that inverse correlation?
Bond yields this morning only higher by a single basis point, the 10-year 4.42. With an update on stories elsewhere this morning with your Bloomberg Brief, let's cross over to Yahara, who has more. Hey, Yahara.
Hi, John. We start with our top story. President Trump declaring a 30% tariff rate for Mexico and the EU. The new rates are set to take effect on August 1st. EU Commission President Ursula von der Leyen responded saying they are working towards an agreement but are prepared to use countermeasures, while Mexico's economy minister called the new levies unjust. Meanwhile, President Trump and his allies are ramping up pressure on Fed Chair Jay Powell. In addition to criticizing Powell for not cutting rates, they're now focusing on his handling of the renovation of Fed headquarters. The Fed says the renovations are designed to reduce costs by consolidating its operations, but critics are focusing on what they call extravagant design features. And Amazon's Prime Day sale, which was doubled to 4 days this year, helped boost overall online spending in the U.S. by 30%. The data from Adobe included sales for Amazon and its competitors Walmart and Target, which hosted their own sales. Consumers mostly stocked up on household items rather than pricier goods like electronics. That's your Bloomberg Brief, John.
Yahara, thank you. More from Yahara later this hour. Up next on the programme, EU tariff tensions.
The European Union is talking to us. They want to open up their country.
We must prepare for all outcomes, including, if necessary, well-considered, proportionate countermeasures.
That conversation up next with Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. Quiet start to the week. It gets busier tomorrow morning. CPI 8:30 Eastern Time, Tuesday morning. Sandwiched between a lot of bank earnings Tuesday and Wednesday. Equity futures right now negative by a third of 1% on the S&P. We're down by 0.4 on the Nasdaq 100. Under surveillance this morning, EU tariff tensions.
The European Union is talking to us. They want to open up their country. I would say Japan to a much lesser extent in terms of opening up their country. South Korea wants to make a deal other than tariffs. So some of these deals, maybe I'll change them and maybe I won't.
So here's the latest. The European Union preparing to respond after President Donald Trump threatened 30% tariffs on the bloc as talks with the US drag on.
I intend to speak with my US counterparts again later today. The current uncertainty caused by unjustified tariffs cannot persist indefinitely, and therefore we must prepare for all outcomes, including, if necessary, well-considered, proportionate countermeasures to restore the balance in our transatlantic relationship.
Joining us now is Bloomberg's Tyler Kendall. Tyler, the EU versus the US, it was all very, very quiet. Now it's got a lot louder.
Yeah, exactly, John. Although it is perhaps the EU taking a more measured response here going forward, saying that they will delay their own retaliation until August 1st in a bid to keep negotiating with the U.S. But it was interesting to hear. You heard the EU trade chief there. He went on to tell reporters that there is a new sense of urgency, in his words, for the trading bloc to engage with its other trading partners. And Bloomberg News had reported earlier this morning that contacts with nations, including Japan and Canada, could lead to potential coordination between them against the United States. We know that the EU Commission President Ursula von der Leyen will be speaking with her Canadian counterpart, the Canadian Prime Minister Mark Carney, later on today. It's also probably worth mentioning that the EU actually reached a preliminary trade framework with Indonesia over the weekend, as EU officials have said perhaps there could be more of a focus on Southeast Asia and the Pacific. This tariff letter from President Trump really did appear to dampen perhaps the negotiations, considering our understanding had been that there had been progress and that the EU was moving up in line when it came towards the potential for a deal. The thing is, as you well know, there are just so many sticking points here. We know the U.S. has wanted to see greater market access for its agricultural products, for one example, and the EU has really been focused on those sector-specific tariffs. John, we know there is an emphasis here when it comes to autos, but it's also probably worth pointing out that some of the tariffs that haven't even been enacted yet, those tariffs under Section 232 on the grounds of national security concerns that we are still waiting for, like pharmaceuticals, are also still hanging over these negotiations.
Tyler Kendall with the latest in Washington. Tyler, thank you. To Tyler's point, still waiting for the sectoral tariffs from the White House.
Exactly, and they have been signaled from this administration a number of times. We did get copper, we have aluminum, we have steel, but what's going on with chips and what's going on with pharmaceuticals? And for some trading partners, like the European Union, like Japan, that almost potentially could be more important than the cross-the-board, what they would call reciprocal rates.
Well, let's stay on Europe. Here's a view from Henrietta Treyz of Veda Partners. Quote, there has been a split view in the EU over whether to retaliate against or negotiate with the United States. Since President Trump announced 30% tariffs on the EU, the retaliate team has been getting louder. Henrietta joins us now for more. Henrietta, welcome back to the show. That last word, retaliate, what about the prospect of coordination between the EU and partners?
You know, with trade, it's all about the negotiating partners, whoever the party is, expanding the cards in their deck. So if you can retaliate and you can also coordinate with other partners, all the better. And that's plainly what the EU is doing. And they are working, as Tyler just pointed out, to reach deals with Indonesia and other Asian trading partners to find a way to offset the, very clear permanent negatives that are coming from the United States in terms of these tariffs. And the only question I really have is whether the rate stays at 10% for them or whether it rises to 25%. And those sectoral tariffs are much more damaging and really create huge tensions within the EU bloc to negotiate. How do you strike a deal that works for autos but not pharma and leaves out Ireland, for example? Those are all the issues on the table.
Henrietta, when it comes to coordination potentially with Brussels and other capitals around the world, is it going to help or hurt their hand in Washington?
I mean, honestly, I'm not sure how much worse it can get. They are holding off on retaliating. They did go back and forth for a couple hours yesterday morning, which was interesting to watch. As I mentioned, the retaliate team is getting louder. But I think that they are trying to deploy as many alternatives to the United States as possible to strengthen their hand. Because frankly, the president is not moving away from the tariff struggle. The market is giving him free rein to do so. And the EU basically has to do whatever it can to try to, increase the cards in its deck.
Well, is every card being used? Like the German defense minister visiting Washington today at the same time that Berlin is in talks with the U.S. about providing weapons for Ukraine and footing the bill?
Yeah, so the Ukraine component is, I think, a really big deal. And the president is under extreme pressure from not just the EU on that front and getting support from France and other nations saying that they're going to increase defense spending. But he's also under pressure from the United States Senate. And there are 83 senators or more who want a really robust sanctions bill to pass, which not only requires a 500% sanction that would go into effect on any nation helping Russia, but also would sort of hamstring the president in terms of what he can do unilaterally and force his hand. And that's exactly what the president does not want. So the EU does have some allies on its side when it comes to being pro-Ukraine and anti-Russia. And that's coming directly from, sort of inside the building from the United States Senate.
Henrietta, how cohesive is Europe right now when it comes to how to counter the United States? And I ask this as the German Chancellor Friedrich Merz said over the weekend that if 30% tariffs would go forward, it would hurt Germany's industry to the core, and so they would have to even postpone key aspects of their economic development plan, really kind of saying, look, we need to find another solution.
Yeah, and that's exactly the strategy of the United States right now. The purpose is to split the EU bloc. And I think if you talk to some folks in D.C. or in the administration, if that's their strategy, they wouldn't be mad at it. I mean, they want to go after very specific sectors to try to get Germany to exert pressure on Italy, or to get Ireland to exert pressure at wherever it can over pharma, or France, whatever they can do on the agricultural front. So it's really about going after as many individual players. And that's why you have 232s across 8 different sectors right now, from steel and aluminum, which hits the EU, autos, pharma, coming on a whole host of other sectors, including aircraft and jets and engines. Those are all the levers that the U.S. is trying to pull to fracture the EU to the extent possible to eke out the best deal.
Henrietta, always great to get your views. Henrietta Treyz there of Veda Partners. Headlines you don't expect to read: China, record exports, record surplus in the first half of the year, even with the trade relationship between the US and China collapsing, the exports from China to the rest of the world exploding.
Yeah, where in particular Southeast Asia, and you saw a 16% decline in exports to the United States. We have to dig in to understand exactly how much is going to Europe, and there are lots of people who will raise questions about the credibility of this data. But
As they should.
But there is this question about transshipments and how much of that exporting volume to Southeast Asia is just getting rerouted right back to the United States, and whether that's going to be something that the president can stop.
Exactly. For the month of June, it was down 16% going to the United States. But those Chinese goods are still somehow ending up in the United States. And I wonder if you're a U.S. official looking at this data, you're thinking, where do we need to go after when it comes to transshipping? They're trying to work this out with Vietnam. Who else?
Need to force it on everyone else for this to work. Equity futures right now in the S&P down by a third of 1%. Up next, RBC Capital Markets US head Vito Sperduto on the outlook for M&A ahead of earnings season. Plus, your Hauer with your morning movers. Fox getting an upgrade on its advertising pricing power. Live from New York, you're watching Bloomberg TV. Equity futures so far in the S&P negative by a third of 1%. A small week of losses on the S&P 500 last week. With Friday's losses, we just missed out on a third week of gains. A third week of gains would have been the longest weekly winning streak of the year so far on the S&P 500. On the Nasdaq, we're softer by 0.4%. Similar move on the small caps on a Russell 2000. With 2 hours until the opening bell, let's get you some morning movers with more. Here's Yahara. Hey, Yahara.
Hi, John. As you said, futures are lower, but I managed to find some stocks bucking that trend. And we start with Fox. Shares are up 3.75% after Wolf Research upgraded the stock to peer perform, pointing to the strength of Fox's news and sports businesses. They're saying that NFL broadcasts continue to deliver strong and stable audiences for them, and that they see no signs of an advertising slowdown for now. And we move on to shares of Synopsys. They are higher 3.5% after the chip design company secured approval from China to buy another company, Ansys, for $35 billion. The deal between these two U.S. companies needed Beijing's sign-off because China, as we know, remains one of the largest markets for semiconductors, and regulators there wanted assurances that Synopsys with this deal would not cut off Chinese customers. So a big hurdle cleared for them. And we end with some more optimism. Take a look at crypto-linked stocks, MicroStrategy and Coinbase, all higher, riding Bitcoin's latest move higher as it soars to record highs, reaching $122,000. And this is coming as Congress gears up for Crypto Week, where they plan to take on crypto legislation. John?
Yahara, thank you. Appreciate the update. On our radar this morning, our top story. President Donald Trump reiterating his call for lower interest rates, saying Fed Chair Jay Powell should quit. Administration officials also ramping up criticism of Powell's handling of an expensive renovation of the Fed's HQ.
They're throwing everything at him, and they're trying to find justification for why they can fire him. And the market is sort of shrugging it off and saying either this is just theater optics for some of the Kevins to audition more publicly, and maybe this isn't something that could actually change the dynamic of the FOMC just simply because it's not just a one-person FOMC. There are other members, too. To me, the fact that Kevin Warsh brought up a regime change for the Fed, talking about some sort of shift in the composition of the committee and overhaul, that made me take notice. Maybe that's just he wants to get into the front seat in this race.
That made me take notice to the fact that what they really do want is more seats to fill people that have their worldview, which makes me think that it is going to be someone like Governor Waller. Because if Powell decides to leave when his chairmanship is up, because he could stay until 2028, they want that seat for someone else to agree with people like Governor Waller that are currently on the board.
I've got no idea who's going to be chosen. But if you wanted a credible voice for someone making a credible argument for lower interest rates, he's on the Federal Reserve already. His name is Governor Waller.
If you put a Hassett in, I think the market will respond pretty dramatically because it will be considered somebody who is a political ally of this president. Warsh, you say the worldview. What is his worldview, considering that he was relatively hawkish? The bigger question is, how much does this affect the dollar more than even yields? Because it really goes to the heart of credibility of the United States. And if you start drawing too many parallels with Turkey, that's not a great thing.
Right now, it's not affecting anything. Bond yields are higher by a single basis point. Let's turn to trade. The EU planning to engage more with other countries hit by President Trump's tariffs. Sources telling us here at Bloomberg the bloc could potentially coordinate with Canada and with Japan. This is a change.
This is a change, and they're looking for leverage at the same time that they're trying to get the European nations to coalesce around some sort of plan of how they're going to counter the United States. This, to me, was one of the most interesting things. Henrietta Treyz really highlighting this is the strategy of this administration, to split the defense. This is sort of the classic football move to use, or soccer move. You want to try to create dissonance among the European allies so that they come together and actually have to accept it or negotiate and accept pain. I'm going to keep watching to understand exactly how they're doing that.
It's that forever question. If you're sitting in the White House, you want to call Europe. Who do you call? Who's answering the phone? Is it Ursula von der Leyen? Is it the German chancellor who's sending his defense minister to Washington today to talk about Ukraine and defense? Or is it someone like Giorgia Meloni, who we've seen had this outreach to the Trump administration, individual who's made her way to Mar-a-Lago before he wasn't even inaugurated? It's a challenging moment for the European Union because it really is hurting cats when you're dealing with all of these different countries.
You mentioned Germany and defense. Worth mentioning this story that the president is saying the US will send more Patriot air defense batteries to Ukraine. His comments coming ahead of what what he described would be a, quote, major statement on the war later on today.
So he said he haven't agreed on a number yet, but he said he's going to send these Patriot defense missiles. The big question going today is, will he send anything that's more offensively? And also, when you have the German defense minister, Boris Pistorius here, they're the ones that are saying maybe we can help pay for some of this that's going to Ukraine. The second thing to watch for today is, does the president signal that he is in favor of this bill that is working its way through Congress? The number of Republican senators want to see, and this will make it much more challenging for Russia to export crude to China and India, basically the two biggest economies they're going to.
And by the way, does he link the two issues on trade and on defence? If we do this for the Europeans for Ukraine, what are you going to do coming back? And by the way, we don't like what we heard in a Bloomberg News story earlier this morning that you're looking to coordinate with trade partners to make it more difficult for us.
I absolutely think the president views all of this as one and the same. He will say, we are doing something for you on Ukraine. Now you need to help us when it comes to trade.
Three of the big stories so far this morning. Let's turn to deal making. The M&A market in focus ahead of a big week of bank earnings. Vito Sperduto of RBC Capital Markets saying M&A activity is delayed, not derailed. Writing the backlog of M&A opportunities continues to build. Deals will happen. They're just not happening as quickly as many had expected. Vito, it's good to see you. Good morning.
Thank you for having me.
The difference between those two words, delayed and derailed. What inspires confidence that this is just a delay and not a derailment?
Well, I think the fundamental conditions have continued to be very solid. I think the corporates are sitting flush with cash, more so than they have historically. I think for clients, for instance, we're open to lend to clients to support their transactions, much like we were earlier in the year. I think people have gotten comfortable with the current environment. They are operating in an environment of constant uncertainty. And so when you talk about whether it's tariffs or other policy coming out of D.C., you have to plan for multiple scenarios. And so what we're finding with our clients is that they're preparing for transactions. There's a fair amount that they'd like to do. They're continuing their plans. It's just a question of when do you make the decision to do it. And so it's delayed to the right. It's not being taken off the table. And so I think there's a fair amount of activity when the window does open.
A lot of people said it was a wait-and-see economy, and then Delta Airlines happened. And Ed Bastian came out and said that things are stable, businesses have clarity, they're investing again. Have we broken out of that wait-and-see economy?
I think some have. I think we're seeing it certainly. I take a look very closely, for example, at the CEO Confidence Index out of the Conference Board. So the median there is 50 on a scale of 0 to 100 in terms of the inflection point. In the first quarter, which was taken in February, CEOs were at a 60, meaning that they were confident in the forward outlook. They felt positive about it. The survey that was taken in mid-May dropped to 34. It's the biggest quarterly drop that you've seen. So what happened between February and May? Liberation Day. So that tariff and policy uncertainty, concerns about geopolitical instability, and then also an uncertain regulatory environment in some cases has driven them to not make decisions. And so when they looked at that, a very high number of them felt that we were in a worse position versus 6 months ago, back in May. But what we are seeing is that, look, I think you look to Trump 1.0 versus this, it took a full year of the first administration for people to get their arms around what it meant. I think it's happening quicker now, and I think the better companies are prepared, and they're going to enact policy.
The pipeline is rich. The pipeline is there. Look, I think that one reason why a lot of people are looking at this is because we are going to get the earnings from JP Morgan and Citi tomorrow, and Wells Fargo, and then from Morgan Stanley and Goldman Sachs on Wednesday. And people are wondering how much of a boom this is going to be to them, considering that heading into this year, it was supposed to be the year of M&A. Didn't happen. How much has that been derailed?
Well, I think you're seeing, if you look at M&A volumes this year, announced volumes, it's actually up versus last year. But a lot of those transactions in the first quarter were things that were already on the books about to happen. And so you have U.S. M&A announced volumes are up 16% this year. Globally, it's up 26%. But it's really larger deals, $1 billion plus, are driving that. And the smaller deals, sub $1 billion, are actually slightly down in value. So what's happened is a lot of it's just been, like we talked about, pushed to the right. People should not be surprised by this. Like I said just now, this is what happened back in 2017 during the first administration. But what we are seeing is that where we sit today versus the beginning of the year is that there has been a tightening of the bid-ask spread. I think parties that are prepared and feel confident are out there doing transactions. I think sellers that need capital and need to, for instance, if you're a private equity firm and you need to return capital to your LPs, you're looking at various alternatives. It might not be a traditional sale, but maybe you look at a continuation vehicle. Maybe you're looking at some structured equity. Maybe you're looking at a minority sale or taking a loan on your net asset value. And you're finding ways to return capital because that's the lifeblood of what they need to do.
I wonder how much the scenario for how people are financing these purchases has changed with yields where they are. Have you seen people less willing, or companies, not people, companies less willing to incur debt to make those purchases and wanting to do it in all stock or crash or whatever, just simply because of the fees?
I think if you go back 2 years ago, a year ago certainly, I think people had not accepted this new level yet. I think they've accepted it now. So they understand rates higher for longer. I think if you look at where the calls are, for instance, our rate desk just pushed out their call last week that instead of a first cut happening in September, it's now going to be December. Just because it's too short of a window to August 1st or to the September meeting to really see any statistics that will allow the Fed to cut. And so as a result, I think companies are saying, I'm going to be in this environment longer. I need to make the right decisions for my business. It's too soon to just focus on 26 and beyond, but I think a lot of folks are looking at their more longer term plans. And as a result, you're seeing them make decisions that are strategic. I always like to say good strategic transactions will happen, and we can find a way to support them and finance them. And we're seeing that with our best clients.
But Vito, what's the risks in delaying?
The risk in delaying is that someone else takes advantage and you're sitting on the sideline left behind. And so we're seeing a lot of activity in some sectors where folks are feeling that, for example, if you look at the technology sector, I think folks are trying to build their pipelines from an AI perspective, and they're looking and saying, I need to be in here quickly. I can't wait to develop this on my own. I'm going to acquire it. If you think about some other sectors like industrials, they're looking to diversify their supply chains and think about making sure they've got ample supply in various geographies and so that they're tariff resistant. And they know they have to operate in this environment. We know it's going to not necessarily be what's out there in terms of a headline today, but we don't know what that's going to be. And I think they're planning for various scenarios.
Just finally, Lisa brought up the price of money. Do rate cuts make a difference? Do they move the dial?
I think, as I started before, I said we're looking for a signal for sort of people to make decisions. I think certainly rate cuts would be a good signal to the market and to buyers and sellers that this is an environment where we're ready to transact and there's a level of confidence there. M&A is about aligning many different factors. And so you need your management teams, you need your boards, you need them all to have confidence in the forward outlook. If they feel that the Fed's giving a strong signal like that, I think that's a positive. But at the same time, I think the better companies are prepared to act in this environment. And so, again, I jokingly say we always have a pretty full pipeline. It's pretty full right now, but I'd love to see a lot of that transition to announced transactions.
You're certainly not alone. It's good to see you, sir. Thanks for dropping by.
Thank you for having me.
Vito Sperduto there of RBC Capital Markets with an update on stories elsewhere this morning. With your Bloomberg Brief, back with us, here's Yahira. Hey, Yahira.
Hi, John. An initial report on the crash of an Air India aircraft last month says fuel supply to both engines was switched off just seconds after takeoff. The report does not reveal why the fuel switches were moved to a cutoff position on the Boeing Dreamliner, nor who did it. The crash killed all but one of the 242 people on board. Meanwhile, Elon Musk says he's planning a shareholder vote on Tesla's investment in his own AI startup, xAI. In a post on his social media platform X, Musk said if it were only up to him, the EV giant would have invested in xAI a long time ago. His comments came after the Wall Street Journal reported that his other company, SpaceX, had agreed to invest $2 billion in xAI. And top-ranked Jannik Sinner defeated Carlos Alcaraz 3-1 to win his first Wimbledon championship and the first for an Italian. It's his fourth Grand Slam title overall. The contest was a rematch of last month's epic French Open final that saw Alcaraz come back to win. This time it was Sinner's turn. That's your Bloomberg Brief. John?
Yahara, thank you. The resilience of tennis players to bounce back from the French and the loss that Yannick just had. We've got 10, 15 more years of this. 22 and 23 years old. Just amazing.
To bounce back from the French, you mean just tennis players or the Italian tennis player who took the helm? Just want to say.
The Italian player that bounced back
yes.
and everyone that's been following
Against
him.
the French.
All right?
Okay, carry on.
Everyone's supporting him.
Okay,
we're done. Up next on a program, housing, disinflation.
Inflation's coming down. Of course, we get a big CPI report, but we're at the lowest level since 2021. There's significant disinflation coming from the housing side. I wish more people were talking about this right now.
We'll talk about it in just a moment with John Lovallo of UBS from New York. This is Bloomberg. He just sensed confidence this morning, confidence that the price of tariffs this high is too high and they won't follow through. Confidence that the price of firing Chairman Powell is too high and they won't follow through. Equity futures this morning down by 0.25% on the S&P. On the Nasdaq, a similar move. In the bond market on a 2-year, 10-year, 30-year, you'd have no idea the kind of pressure Chairman Powell was under. Yields are higher by just 2 basis points. The 10-year, 442.73. This from the team at Evercore. We doubt Trump will actually fire Chairman Powell. Bessent likely warning of the mayhem this would cause in markets. Serious doubts the Supreme Court would even uphold the decision.
Which maybe explains why yields are up just marginally in the United States, even as they're up much more around the world for other unrelated reasons. Question is, are we playing a big game of chicken, where people are waiting for people being President Trump, waiting for the markets to respond, and when they don't respond, he says he's a green light to just keep going?
Keep pushing. Yields this morning pushing hard by just 2 basis points. Tomorrow morning, inflation data on deck. Under surveillance this morning, housing, disinflation.
Inflation's coming down. Of course, we get a big CPI report, but we're at the lowest level since 2021. There's significant disinflation coming from the housing side. I wish more people were talking about this right now. We have the most homes on the market since 2020. Demand is slowing in the face of unaffordability. There's enough disinflation on the shelter or housing side to potentially overcome any goods-driven tariff inflation that we see.
So here's the latest this morning. Shelter costs in focus coming into tomorrow's CPI report. John Lovallo of UBS writing investor sentiment appears to be improving and the focus is shifting towards the prospect for a housing recovery in 2026. John joins us now for more. John, good morning.
Thanks for having me, John.
Annmarie Hordern just there. Let me read out some of that. Inventory, homes on the market, the most since 2020. Demand is slowing in the face of unaffordability. How would you describe the current backdrop?
I think it's I've said this before, but it's a tale of two markets. I mean, existing home inventory is still very low. New home inventory has picked up in certain markets. We could talk about the I-4 corridor of Florida between Orlando and Tampa. You could talk about Austin. You could talk about Phoenix. But the builders had done the rational thing, and that is try to fill the gap of not having enough existing home inventory. Now, things have slowed a little bit more than people had expected. And again, they're doing the right thing, and they're pulling back on production. So our view is that as we work through the end of this year, that inventory is going to be in a lot better spot.
Housing recovery. What does that mean? Does that mean prices going up? Does that mean more transactions? Or does that mean that there's just going to be a balancing where you're not going to see as much inventory in a number of the places that you're talking about?
Lisa, I think it's a little bit of all of those, right? I mean, I think you see inventory get worked through. But most importantly, look, consumer confidence appears to be stabilizing. Right. And along those same lines, investor sentiment is stabilizing. And as that quote said, they're looking towards a 2026 that could be a little bit better. And just as importantly, I think that there's an expectation that we may see one more cut in earnings, but it will be less pronounced than it's been in the second quarter here. And it will be the final cut. And that is generally when you want to get involved. So I think inventory gets better. I think consumer confidence improves, pulls buyers off of the sidelines and back into the market. And we start to see a little bit of an improvement in the overall housing market.
But to Emily Rowland's point, there has been a disinflationary force given how much inventory has built up in a lot of places and the fact that a lot of people feel locked out of the housing market because rates are too high and prices are too high. And even people who want to have renovations, they worry about the cost of materials and things of that nature. I'm just wondering how much you see people absorbing higher prices if you see this as a source of inflation or ongoing disinflation.
Yeah, it's a really interesting dynamic where this disinflation is being driven by several factors, right? If you think about about it, historically, new homes have commanded 17 to 18% premium to existing homes. That is zilch. They're equal. But now keep in mind, what's driving that is a lot of mix. And what I mean by that is the builders are realizing that, hey, affordability is a real challenge. So what we need to do is build smaller homes, a little less amenitized, a little further away from the city to bring these prices into ranges where people can actually transact.
Can you get a housing recovery without a Fed rate cut?
I absolutely think you can. If you think about the 30-year right now, we're at 6.8%. If you think about last year when we had a really strong market, we were over 7% for most of the year. I think what's most important is stabilization. Think about it. The volatility we're seeing in mortgage rates makes it very difficult for consumers to go out and purchase, makes it very difficult for the businesses, the companies, to actually figure out how to plan their businesses. And, there's just this uncertainty is not good for anything.
And you think part of that uncertainty is also driven by what's going on in Washington in terms of tariff policy. What makes you think, if you think there's a recovery in 2026, that the tariff uncertainty will actually stop?
That's a good question. I don't know that tariffs play into it 100%. But if you think about the tariff impact on the housing market, it's actually a lot lower than it is for many other industries. We've estimated 5 to 6% of the cost of an average home. I don't think the builders shield or cover most of that. I think it gets spread throughout the value chain. I think it's more uncertainty about just the overall economy. And, if you're thinking about buying or transacting upon the biggest purchase of your life, which is a house, you want to feel good about things.
Begs the question why the home builders can't get off the map. Because we have seen a recovery in the index level on the S&P 500. Had a lot of guests come on the programme and say similar things to what you're saying, pricing the recovery for 26. Yeah. A lot of people are doing that. Home builders are not. Why is that?
Well, we've had a pretty good run over the past couple of weeks, and I think there's a lot more to come. We're still trading at just over 8 times earnings. Historically, I would tell you an average PE multiple is closer to 11 or 12 times. So we have a lot of room to go. It doesn't take much to get this group going. It's just a little bit of kick in the tail, and you're going to see these things go off to the races.
Is there an income group you want exposure to, the likes of Toll Brothers? Is there a region you want more exposure to? What kind of exposure do you want to take?
I would say that, look, from an income group, and maybe this sounds a little counterintuitive, we still like the entry-level first time because that is the buyer that is most need-based. Think about it, getting married, having children. Now, sure, you could say that they're more reliant upon interest rates, but then if you think about it, there's a $62 trillion wealth transfer that's happening in the U.S. 25% of first-time buyers say that they receive down payment assistance. This buyer has also done things a little later in life, so they're a little better financed, and they need that space. Now, to your point, though, John, we like the higher end as well. It's a sort of a barbell approach where those folks, the Toll Brother buyer, is still spending a lot on options and upgrades, and that's very accretive to margins.
I think you and I are thinking of the same thing, aren't we? Yes. Down payment assistance.
Yeah, you need rich parents, and then you're fine. That's
Bank of mom and dad. Bank of mom and dad.
100%. It's sort of like, hey, guys, you want, tax-free, pass along the endowment? There you go.
First-time buyers. That's a data point that should be on the desk of every single politician in this country.
Yeah, especially for people who don't have, the bank of mom and dad.
Precisely. John, it's good to see you. Thanks for dropping by. Appreciate it. John Lovallo there of UBS. Up next on the programme, Julie Biel of Kayne Anderson Rudnick, Saul Martinez of HSBC, Michael Darda of Roth Capital, and Mark Cabana of Bank of America. The third hour of Bloomberg Surveillance up next.
Investors are saying that everything is awesome and there's not a lot of risk.
We have a stronger stock market at this point. So that does embolden the president to go forward and be more aggressive now.
There will be very big differences if the tariffs come out at the higher level.
What the market is telling you is that, yes, we're expecting volatility.
We could spend a lot of time thinking about the noise, the volatilities out there. It hasn't paid off to just say, I'm going to stay off the markets.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. 90 minutes away from the opening bell. Your price action looks like this. Equity futures down by about 1/3% on the S&P and the Nasdaq 100 in the bond market. A bit of a snooze stateside for most of this morning. Yield starting to pick up now on a 10-year maturity, higher by 2 or 3 basis points at the long end of the curve. Going into a very busy week. including lots of economic data. It's not just bank earnings, CPI on deck, retail sales as well, and another look at jobless claims.
Key question here, how much are we seeing inflation pick back up, or is this going to be a story of disinflation? Mark Cabana, who's coming up of Bank of America, put it this way. Is it tariff inflation? Is it the ghost of tariff inflation or the disinflation deity? It's sort of which fiction are we living in? And right now the market's trying to toggle between both of those while looking at policy uncertainty and saying, we're going to have a beer and take the summer off.
Bank of America, no cuts this year.
Right.
Morgan Stanley, no cuts this year. Wolf Research, Stephanie Roth on this program in the last week or so, no cuts this year. Wait until the middle of next year. If you think the pressure is big right now on Chairman Powell, wait until later this year if they still haven't cut interest rates.
Especially if you don't see that inflation pick up in the CPI. If there is a lagged effect on the economic data and you are not seeing some sort of hit to companies, well, what is the argument to actually cut rates if the economy is still chugging along? At the same time that you might not have an inflationary pressure, it just raises this question for the Fed. How much do they have to cut? And then also fend off some of these political discussions.
A big question mark, too, for the Fed, and they continuously talk about this, is that they do not know the end game when it comes to tariff rates. Right now, we see over the weekend more hot rhetoric when it comes to the European Union. The European Union has jumped since April 2nd from 20 to 30 to 50 back to 30. When it comes to Mexico, they're now at 30%. Everyone is signaling this is a negotiation time. Well, if there's still a negotiation, they don't settle on a rate, what is the Fed supposed to do with that?
Going through the research over the weekend, there's a few words that pop out. Here's one: complacency. This from Julian Emmanuel of Evercore. Tariffs likely to pressure complacent EPS forecasts. We're actually going to see that this earnings season.
Well, maybe they'll have to. I think it depends on which sector. Are you going to see certain sectors start to indicate that they're going to make a little bit less as they try to avoid passing along some of those tariff costs to consumer? I just keep thinking about what we were hearing about earlier from Leo, the idea that companies already are offsetting this with the dollar depreciation, and that you are seeing sort of long-lasting contracts that make this really a lagged kind of process. My head's spinning. If I seem out of it, it's because you're trying to put all these pieces together and you think, how do we create a cohesive narrative? And that's why so many people are saying, you know what, we're just going to ignore it.
If you seem out of it, which you don't, it's a market with no weekends.
Fair.
That's what it is
true.
now.
Yeah.
There is no 2 days off anymore.
It's honestly some individual in the White House who has endless energy, who does not sleep, who seems to have the ability to just keep going. He is the Energizer Bunny. Kudos to you. I am a lot younger than you, and yet here I am, and I'm trying to keep up.
Half the president's age, still
Yes,
exhausted.
exactly.
Equity futures down by about 1/3% on the S&P. No big drama here stateside. Some drama in Japan, which we'll touch on later this hour. Coming up this hour, we'll catch up with Judy Biel of Kayne Rudnick on the risk of complacency. Saul Martinez of HSBC signaling caution ahead of bank earnings, and Mark Cabana of Bank of America as pressure builds on Fed Chair Jay Powell. We begin this hour with stocks lower as President Donald Trump ramps up trade tensions. Judy Biel of Kayne Rudnick writes the following: relying on aggregated data only spurs complacency. I don't think the markets are completely appreciating the impact of these tariffs. Judy joins us now for more. Judy, welcome to the show. And I have to say, a lot of people don't, for a lot of reasons, including the headline data. We've had a string of softer than expected CPI prints. What is it that you see beneath those headlines that concerns you?
I think my real concern is that the aggregated data can have an effect of ignoring what's happening in the middle. It gives you the high end. So if you see the consumer spending data, it looks pretty healthy, but that's really concentrated at the high end. And that's even if you cross out the Bezos wedding, right? The core consumer spending data is really being lifted by the high end, which is unusual actually. And it shows that there's a lot of weakness in the middle and low end consumer. So I think a lot of the data is hiding a lot of the morass that can be really affecting a lot of companies. A lot of the other issues, too, is that many companies did such a great job front-loading their inventory and holding on to it that I think that the effects of the tariffs are actually going to take some time. Some did better than others, and so I don't think we're going to get a ton of visibility into that, even for corporate earnings. I think many will be able to say, look, we're going to take it on the chin, 20, 40, 50 basis points, but we're going to be okay for the rest of this year. And those are the ones typically that have built a lot of their inventory reserves and are just hoping that cooler heads prevail by the time we get to the end of the year.
Julie, you said that with a straight face, but I really want to dig into that. Are you saying that the Bezos wedding could actually influence some of the retail sales numbers and even inflation?
No, I'm absolutely.
Okay,
no,
all right. But I'm just wondering, if you look forward, right? I'm just asking you this because we are seeing that skew from higher income consumers. And I just wonder, at what point you have to see some of the inflation, or you have to see a sort of top level deterioration in retail sales to say, okay, we're seeing an effect, or okay, maybe we're not going to see an effect. And actually, the United States and the consumer can absorb these tariffs without seeing the hit that many people expected.
I think it's a matter of scale, right? And so if you assume that the tariffs are on the order of 15 to 20% for the foreseeable future, which is kind of what it feels like it actually could even be even higher. That's almost a doubling of the corporate tax revenue that we should be expecting, right? Because it's very clear that our trading partners abroad are not paying for it. You would typically see their currencies devaluing if that were the case, and that's not what's happening, right? Our currency is the one that's devalued. So it's either companies are going to be paying for it or consumers are going to be paying for it. And if you look at tax receipts last year on the corporate side of $525 billion, and you look at what tariffs would be, it's comparable. So that's a large increase, and someone's going to have to pay that bill.
Do you think that people are underpricing the risk to companies outside the United States? I'm thinking of Europe in particular, as they try to grapple with rates that are still in flux, but are inevitably going to be high.
Well, I mean, I think you guys talked about this on the last hour. So much of all of Europe is really trying to figure out who can our more reliable trading partners be, right? The U.S. is kind of acting like that gorgeous girl you remember from college, right? Who just thought she was unassailable, right? And then she gets like a weird nose ring piercing, right? And she just thinks she's so hot it won't matter. It won't matter. But everyone else kind of looks at her like, she doesn't look that great. And also now I question her judgment a little bit. It has long-term effects that we might not see right away, but I think it really has changed the tenor of the discussion in Europe, where people are banding together and looking to other countries. And the same is happening in Asia as well. That's not an immediate effect. That happens over the longer term.
It does feel a bit like high school, and that's the girl who you look back and the reunions and think, really, that's what happened. I am curious, though, going forward about whether you do see this from a market strategy perspective as, really benefiting the rest of the world versus the United States, or do you think that it's a little facile to make this description, given the fact that the dollar still is the reserve currency and the tech dominance still remains in the United States?
I think that's why I make the metaphor, actually, right? Because the girl is still beautiful, right? The U.S. economy is still the most dynamic. It has the most stability to it. It has the most innovation. Our universities are bar none the best in the world. There's so much in this market that is really attractive and creates everyone to want to stay in relations with. But I think there's also this recognition of diversification being good, not just for our portfolios, but for the rest of the world in terms of the stability of their trading partners. And I think what worries me is that in the US, we are not accustomed to any kind of suffering or discomfort, right? You lose your internet outage for 20 minutes and you lose your mind. Europe and Asia, for sure, most countries in Asia, they're much more used to being able to buckle down for more communal reasons, and such as kind of the own pride of your own country. That's a difficult dynamic where they may be willing to walk away from easy profits in the U.S. towards having more stability and more comprehensive outlook.
So, Julie, just to be clear, what do you like right now? What would you be buying?
I still like companies that have a lot of quality and durability to their earnings. And so they're in the more kind of sleepy industries. There are parts of software that I really like where they can benefit from AI, but you may not know them very well, like a Descartes that works in trade management software. I think the companies that you want to have a lot of clarity and confidence that their earnings are going to be there. Think of like a FICO or an Equifax. Those are the types of businesses that I think you're better off owning right now.
I'm not going to ask you who the hot girl with the nose ring was at college. We'll let you go. But I'm sure she exists. That felt real. It
wasn't me. I wasn't pretty enough for it, for sure.
That felt real. Julie, appreciate it. Julie Biel there of Kayne Anderson Rudnick. Thank you very much. That and Italian GDP, ex-Bezos.
Yeah, honestly, all I can say is it does feel high school. I think that's the reason why it's an apt analogy. I wouldn't say that that's college. I think that that's high school. I hope that people grow out of that whole phase of, who's hot and who's not and who got a nose ring. Oh, my God, did you see it? Like that kind of stuff? Really?
Well, to the point is, the United States is still a hot place. The economy is still chugging along, even though we're in the midst of all of these back and forth, tit-for-tat trade headlines.
On a serious note, Microsoft, in the past few weeks, look what we learned here at Bloomberg, saving hundreds and hundreds of millions of dollars shifting, I think, call centres towards AI. That's the amount of cost saving we could see, not just for the tech players, but across the S&P 500 in the next few years.
This is the reason why people are saying how tariff dependent are some of these equity valuations, even if in the short term profits don't increase that much, which was Lori Calvasina's point in that recent upgrade of the of her S&P target.
Nasdaq futures this morning down by only 1/3%. With an update on stories elsewhere this morning, we'll get back on track with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. The EU is preparing to further relations with other countries hit by President Trump's tariffs. That's according to sources familiar. The EU competition chief said it is looking to deepen trade agreements with India and other countries in the Asia-Pacific region. The bloc suspended retaliatory tariffs on U.S. goods that were scheduled to take effect today. Meanwhile, Warner and DC Studios' Superman debuted at the top of the North American box office this weekend. According to data released by ComScore, the movie grossing $122 million. The film starring David Cornsweet in the dual role of Superman and Clark Kent currently holds an 82% approval rating on Rotten Tomatoes. And Sotheby's New York has a new item going up on Wednesday. The auction house will be selling NWA 16788, which is the largest piece of Mars ever found on Earth, coming in at 54 pounds. The meteorite is believed to have been blown off Mars' surface by a massive asteroid strike before landing in the Sahara. The estimated auction price is between $2 to $4 million. That's your Bloomberg brief, John.
Yahara, thank you. Sounds like something Elon might buy, right?
I have to be honest, I think that's really cool. I really do. I don't know that I would
prefer
say
the Ken Griffin dinosaur.
Yes, that's actually pretty wild. Cool. Yeah, but both are kind of awesome.
That's like living the 8-year-old's dream.
Yeah,
Give an 8-year-old a fortune, they'd buy the dinosaur.
It's true. And at the same time, it's just, where would you put it?
Where is the dinosaur now? Do we know?
I don't
Museum
know.
somewhere?
I don't know.
I hope.
Or maybe it's in his home. Maybe it's his living room.
I'll find out in the commercial break.
At the dinner table.
Big enough. Based on some of the housing that Kenny G's got.
Yeah, that's true. Fair point.
Up next on the programme, the morning calls plus Saul Martinez of HSBC signalling caution ahead of bank earnings. That conversation up next.
He probably should have cut rates or be on the pace we should be cutting in July. I don't agree with all this policy, but I think pushing him out and this pressure, markets aren't going to like it, the world's not going to like it. So I don't love that strategy. I think it's actually going to be a muted reaction. A shake-up and kind of some different thinking wouldn't be a bad idea. Again, I'm not sure that it should be done in this kind of, very quick and rough way.
Tchir of Academy making a headline in the last couple of hours. This stood out for me. It's actually going to be a very muted reaction if they fired Chairman Powell. I have to say, that is incredibly contrarian from Tchir.
A lot of it depends on A, who they replace him with, but B, the composition of the rest of the committee, because barring some sort of constitutional change, doesn't seem like the president has the ability to open up more seats or make some sort of massive change to a committee that really is a committee.
It's very contrarian because you would think the one thing that is holding the administration back from already doing this, given the fact that they have so many problems with Jay Powell, is the fact that they're concerned about the market reaction.
No problems in the markets right now. Let's be clear about that, particularly in equities. Very close to all-time highs, still only pulling back by 1/4% on the S&P on the morning so far. On the session, we're down by 1/3 of 1% on the Nasdaq. That's the price action. Time now for some morning calls. First up, Morgan Stanley downgrading CrowdStrike to equal weight, citing a full valuation and rising growth expectations. Your second call from Piper Sandler downgrading Best Buy to neutral, pointing to long-term competitor concerns in the appliance and TV categories. And your third and final call from Citizens downgrading Goldman Sachs to market perform, saying the bar is high for another leg up. That stock is softer this morning. Going into results. Let's stick with the financials. Big banks kicking off earnings season this week, likely to benefit from market volatility and steady borrowing costs. Joining us now is Herman Chan of Bloomberg Intelligence. Herman, welcome to the program. What are you looking for this week?
Right. So regional bank earnings kicks off on Wednesday. We're looking for a pretty strong quarter. Loan growth that's going to be something that a lot of banks are going to tout, especially on the commercial side. There's been a lot of activity over the second quarter as borrowers prepare for tariffs. And then net interest margin should be fairly stable. So it's going to be a pretty strong result across the board for regional banks.
Herman, we spoke to the capital markets piece of RBC earlier this morning, Vito Sperduto, and we talked about this pickup potentially of activity in the second half.
Mm-hmm.
You expecting that to happen? Do we have the clarity we need for these companies to make the decisions they want to make?
I think a lot of bank management teams are talking about a holding pattern. So there is there's more optimism relative to Liberation Day in April, but they're still in a wait and see mode as to how things shake out. There's still a lot of uncertainty, but on the bright side, things are banks are seeing transactions and credit quality is holding up really well. So blue skies on that front.
Long may that continue. Herman Chan of Bloomberg Intelligence. Herman, thank you, sir. Going into earnings, HSBC downgrading JP Morgan, Goldman and Bank of America opting for a cautious stance after a major rally. HSBC's Saul Martinez joins us now for more. Saul, good morning.
Good morning.
That's quite a downgrade going into earnings season. Yeah. And some of those stocks have now got the equivalent of a sell, I believe. Just help us understand why.
Look, we just think for the universal banks and for the investment banks, valuations are unattractive given this still elevated uncertainty on the macro side. So the money centers in Goldman and Morgan Stanley are up 20 to 40% over the last 3 months. They're trading at anywhere between a 10 and 50% premium on a PE basis to their 10-year historical averages. You sometimes get the point made that they're still trading at pretty big discounts relative to the S&P 500. But they're no longer at outsized discounts relative to their history anymore. They're trading at a fairly narrow discount relative to their 10-year average or close to the 10-year average discount relative to the S&P 500. And obviously, keep in mind that the S&P 500 is over 20 times. The composition of the S&P 500 is very different than what it was in 5-10 years ago. It's more tech heavy. It's more growth stock heavy. So you do have to factor that into your views as well. The other thing I would mention is the deregulation side is certainly a positive. And one of the manifestations of that is buybacks. Banks are going to ratchet up buybacks. We increased our buyback estimates after the favorable stress test a few weeks ago, but they're buying their stocks back at 30% higher stock prices than they were a few months ago. And in fact, if you look at our estimates, we increased the dollar value of our stock buybacks, considerably going into the results. But our share count estimates didn't really change because it was fully offset by the fact that they're having to buy back stock at much higher prices. Those buybacks are dilutive to book value per share. They're dilutive to tangible book value per share growth, and and so we're not actually the number of stocks that they're actually retiring is not different than what we thought they were going to be a few months ago when our share buyback forecasts were much lower than they are today.
A lot to unpack there. I want to just stay on the deregulation theme. And there is this theory out there that for all of those years that you're talking about, a lot of them, these banks were treated as utilities and they were not able to really generate the same types of pre-2008 profits that really made them more of a growth sector.
Yeah.
Why do you reject the idea that some of the deregulation would allow them to behave a little bit more in that risk-taking way that could potentially lead the profitability to be much higher?
Well, I'm not making that argument. I'm not making the argument that deregulation is not good for them. I'm not making the argument that they're going to operate with less excess capital and that there's a potential to grow risk-taking activity, whether that be market making or lending. But they're not under-earning, Lisa. These banks are making returns on tangible common equities in the mid-teen range, high-teen range. They're generating value. They're creating value right now. They're generating. We did a report a few months ago where we looked at the ROTCE evolution or ROE evolution of big banks relative to 10-year Treasury rates to see kind of what the spread is. And they're not historically low anymore. So I do think ROEs are going higher. I do think profitability will go higher. But but in some of these risk-taking activities like market making, they're generating very elevated amounts of sales and trading income as it is. So they're not exactly not allocating a lot of capital there. And loan growth is a function of loan demand as well. So I don't know that you can make the case that they're going to grow lending in a really outsized way anytime soon either.
What about the other side of the balance sheet? John was talking about what kinds of efficiencies could be driven by artificial intelligence and certain technological upgrades. And we certainly have seen JP Morgan at the vanguard of a lot of that. How much could that potentially be a surprise to the upside that hasn't been fully priced?
That's a good question. I do think, and to be clear, we're more cautious on where stocks are trading at relative to the operating fundamentals. We don't have a negative view of operating fundamentals. In fact, we've been pretty positive on the backs until recently. And I do think that you will get, especially the big banks, are investing quite a lot. JP Morgan was $16-17 billion annually, over $10 billion for Bank of America. That does give the big banks a competitive advantage over regional banks and small banks. And I do think that, if they can grow revenues, even low single digits, the efficiencies they get from technology and from the benefits of scale will allow them to generate some positive operating leverage. And that's that is part of the bull case of banks, as long as interest rates don't move down dramatically. If interest rates stay here, for the next couple of years, you do get operating leverage, you do get earnings growth, you do get EPS growth in the double-digit range. I think it's priced in, but that is a benefit for these banks.
You effectively undo some of the risk premium incorporated with tariffs, but your note came out July 7th.
Yeah.
That was ahead of this new end date we had timeline for the Trump administration. Now they punted to August 1st.
Yeah.
Do you need to put back in some concern about tariff?
That's a good question. You read the research now. Yeah, we did reduce our cost of equity forecast. That's nice. I don't think so at this point. But our call is that valuations are not attractive given still elevated macro concerns. And that is obviously one of them. I can't predict what tariff policies is going to be, but I do think the macro dynamics there is more risk than there typically is. And if you do see tangible evidence that tariffs are going to move higher and that it will affect economic growth, then you have to factor in that risk premium that we built in early April, then undid, and now you're doing again, right? But so if tangible evidence emerges that it is having a real economic impact, then we'll have to think about, what kind of risk, what kind of cost of capital we incorporate for these banks.
So this is Bloomberg. We always read the note. It's good to see you.
That's great.
Good to catch up. Thank you, sir. Saul Martinez there of HSBC. A little bit of news for you. Over the weekend, you saw that full court press. The administration going after Chairman Powell, putting the pressure on him big time, from the president to the vice president to the NEC director, Kevin Hassett, with regards to, of all things, the renovation project at the Federal Reserve's HQ. This from Axios this morning. The Fed Chair Jay Powell has asked the central bank's inspector general to review its $2.5 billion headquarters renovation project, which has become a key focus of Trump administration attacks. This according to a source familiar with the matter speaking to Axios. That's the latest on that front this morning.
Because he's getting a lot of questions about it. He wants to talk to the inspector general, make sure he has the answers for why it is over budget.
Up next on the programme, we'll catch up with Mike Darda of Roth Capital as investors await key inflation data. Plus, your Hauer back with your morning movers. Autodesk gaining after dropping M&A plans. The opening bell about 60 minutes away. Here's a flavour of the stock action so far. We're down about 0.2% on the S&P, down by 0.25 on the Nasdaq 100. In the bond market, yield curve steeper. Yields higher at the long end on 10s and on 30s, up by 2 or 3 basis points on a 10-year and a 30-year. Check out Japan, though. The epicenter for global bond market jitters at the moment. Yields higher across the curve steeper, up 10 on 30s, up 6 on 10s. That 10-year last summer was 80 basis points at one point. We've doubled in the last year.
And it comes on fiscal concerns with politicians promising more spending. The global implications here are significant because the Japanese buyer had nowhere to go but outside of their nation for yield. If they can get yield at home and that flood of cash stays within the boundaries of Japan, what does that do to the rest of the global bond market that has relied on these investors to prop up their own prices at home?
Not just bonds, but foreign exchange as well.
Exactly.
That dollar weakness story we've seen so far this year, that might have legs, particularly against the Japanese yen.
And how much does that really affect the inflation story in the United States? Because anything that we do import would be on the margin more expensive. Is that one venue, one way to offset some of the tariffs and pass the cost along to the ultimate consumer?
Dollar yen this morning, 147.36. With 1 hour to go until the opening bell, let's get away from bonds just for a moment. Let's get back to the equity market and get you some morning movers with Yahira. Hey, Yahira.
Hi, John. We start with shares of Autodesk. They are up nearly 7% here on our reporting. that the software provider is no longer pursuing a takeover of its rival PTC. Talks of a deal had weighed on the stock in recent weeks, but no longer. But this deal, well, this merger would have ranked as one of the year's largest deals, not just in the software space, but overall. Next up, we have shares of Kenvue. This is the company behind Tylenol, Neutrogena, and Listerine. Shares are up nearly 6% as the company announces a string of changes as it faces mounting pressure from activist investors. The current CEO will be leaving, replaced by an interim CEO as they begin the search for a permanent replacement. Kenvue is also saying that it is looking for ways to simplify its portfolio. So another consumer goods company announcing some changes. And we end with Stitch Fix also surging up 7.6%. This is the company that gives you a personal stylist and sends you clothes. Well, it got an upgrade by analysts over at William Blair. Now they have the stock at an outperform, saying that they're gaining confidence in the new CEO's turnaround strategy. And I will note that this stock is up nearly 40% since its April lows. John?
Hauer, thank you. Some of the names to watch going into the opening bout. Lots of data to watch through the week ahead as well. Busy week. It includes CPI starting tomorrow. Later in the week, retail sales and jobless claims. With a look ahead, here's Mike McKee. Good morning, Mike.
Good morning, John. It is going to be a very, very busy week and an important one, too, for the Fed, because much of the data are going to inform their decision that they have to make at the end of the month, the July meeting at which the president is going to expect them to cut rates. Unfortunately, the data are going to suggest otherwise, probably, at least according to the Bloomberg survey forecast. Tuesday, we get the CPI, and it's expected on a year-over-year basis to rise by a couple of basis points up to 2.6% from 2.4% now. And that would essentially preclude any move at the end of the month. PPI may also show an increase, especially given the increase in equity trading over the last couple of months. The portfolio management category might be something to watch. We get the beige book, the anecdotal reports about what people are going to be doing, companies are going to be doing. And then, as you mentioned, retail sales. Retail sales expected to slow. That's a thumb on the scale. On the other side, we'll see. We get jobless claims. Do they start to move or not? And we'll see what Michigan sentiment tells us about people's thinking on inflation. The thing we want to watch for tomorrow is a pass-through of some tariffed goods into inflation. We haven't got much so far because there haven't been that many tariffs, but take a look at some of the categories to look for, even if we don't get a big move on CPI as a whole. Vehicles, parts, apparel, electronics, furniture, and household appliances, all things that come from foreign countries here. And then here's an interesting one, beer and soda. I'd sort of forgotten about this, but the tariff on aluminum raises the costs of the aluminum cans they come in. So those could go up as well.
Mike, the last read going into the next Fed meeting. There are some on the committee that might vote for a rate cut at the end of July. The chairman, based on his communications so far, certainly won't. He came in for a ton of criticism over the weekend, Mike. It looks like a new line of attack. Discussion so far this morning is the price of firing the Fed chair. Not a base case at the moment, still a risk and something we have to explore, Mike. How are you thinking about that at the moment?
Well, my guess is the markets would react quite negatively. The first question is going to be who takes over. And if it's one of the Kevins, as you've heard in a lot of the research, that might provoke a bad reaction from the markets. Now, if the president were to fire Powell, I don't think anything will happen in the short run in terms of the Fed, because the Fed will go to court to try to prevent it. The Supreme Court's already given them something of a carve out. And if you're going to fire somebody for a cause, you have to prove it. And I would just point to everything that's been happening in the courts and with Donald Trump. It takes a very long time. So this could take us into next year or longer for any kind of resolution. But if he were to have to leave, then John Williams would temporarily take over as the chair of the Open Market Committee, which is what's important. And Philip Jefferson would take over as the chair who runs the rest of the Fed. So there are procedures in place to keep the Fed going. It's a question of whether and when it could happen.
Mike McKee on tour. Mike, you enjoy yourself. It's good to see you, as always. Always in a cabin somewhere.
So there are 2,000 people who live in Victor, Idaho. I had no idea. I was looking.
What is he doing in said Victor, Idaho?
I don't know, but it looks really beautiful. It looks like it might still have snow there.
Because he has the fireplace on, and it's very hot right now in New York.
We've said it a few times on this program. This market will get a vote on all of this long before a court decides or the Senate has a confirmation hearing. This market will get its vote.
At this point, though, the market needs to see the whites of the eyes of some reality versus just jawboning, because this market is sort of immune to some of the threats just simply because there have been so many, and they have been fooled so many times that they just really don't want to get faked out again.
Tomorrow, we get some data. Mike Darda of Roth Capital writing this. Given the Fed's wait-and-see approach, prospective CPI readings may take on greater importance for risk assets in the months ahead. Mike joins us now for more. Mike, welcome to the programme, sir. What are you expecting tomorrow morning?
Thank you for having me back on. So consensus is expecting a 0.3 rise, both headline and core. So I don't really think that is going to change the mood on the Fed. It's a very divided committee, as you guys were just discussing. I'm not super worried about a big inflation spike here. And the reason I say that is bond market inflation expectations are very low and steady. Some of the higher frequency data actually looks pretty good. There's a gauge called Trueflation, which is based on 80 million prices in blockchain technology. Super high frequency. So we have, year over year readings extending into almost mid-July here, 1.7%. So I don't think we need to worry about a repeat of that 3-year inflation overshoot, which was really an aggregate demand monetary policy story. The tariffs could definitely create some inflationary headwinds, but I think they are temporary, and the Fed probably is best to just look through them.
If that's the case, Mike, do you see this as a time for the Fed to be cutting, especially if this CPI print that we get tomorrow shows that ongoing disinflation, or at least not an inflationary trend?
Yeah, I think so. I think they're getting much closer to that point. Probably September. That's what markets are priced for. Fed funds futures are priced for just under 100 basis points of rate cuts over the next year. That sounds like a lot, but it's really not over a 12-month period if the economy is softening a bit at the margin. And I think, some of the data suggests that's the case. Not falling off a cliff for sure, but we are seeing a little bit of softness at the margin with, the most recent jobs numbers. And also, it looks like GDP underlying growth, real final sales to the private sector probably ran around 1% or so in Q2. So that's much softer than what we've seen over the course of the last, 2+ years. So I don't think it's inappropriate for the Fed to be starting to consider lowering policy rates here. But I will say this, the hectoring from the White House is wholly unhelpful. I mean, even if the administration were to convince Powell to step away from the Fed, and this stuff about the construction project is just a fig leaf, it's pretty obvious what's going on here. It's completely out of line in my view. But even if you were able to convince Powell to step down and someone else takes over, it's a committee. They operate by consensus. So it's really very unlikely to dramatically change the rate path in any event. So it's
hold on
just
a second, Michael, because this is actually one key question that the market has, right? That people are questioning whether the market is pricing in some sort of firing of Fed Chair Jay Powell, and would it have that big of a reaction at all? Peter Tchir was saying no, that it is a committee and that people would look through that. How much does it complicate a message that actually would go the president's way if he followed the economic data, at least in your opinion? How much does it complicate that kind of messaging from a Fed that wants to appear independent?
Yeah, that's a great point. I think, if anything, this hectoring and the political pressure probably makes it more difficult for the committee to move forward with rate cuts. And because they don't want to be viewed as, a bending to political pressure. So I think, if anything, these kinds of shenanigans are likely to backfire. And it sets a terrible precedent going forward. I mean, the Fed should be an independent institution. We can look back at what happened with President Nixon when he pressured Fed Chair Burns to inappropriately run easy monetary policy, setting off a decade of inflation, which eventually culminated in double-digit interest rates. We saw a situation in Turkey where President Erdogan tampered with the central bank, wanted low rates, easy money policy, a currency collapse, and hyperinflation followed. So let's get back to basics. If you want low market interest rates, what do you need? You need price stability, and I think the Fed is well on their way to achieving that in terms of on-target inflation. And you need budget integrity. And the Fed has nothing to do with that. In the administration, in my judgment, and Congress are certainly not on that path with the so-called big, beautiful bill that was miles and miles away from an optimal outcome.
Jonathan's been talking about this Deutsche Bank note about the risks of, if Powell was to be ousted, are underpriced. What kind of market reaction could we see if we've come to that point?
Well, it's very uncertain. I think it's just a matter of setting a very bad precedent of political tampering, or the attempt to tamper with an independent Federal Reserve. And you look back at history, and politicized central banks don't achieve optimal outcomes. They might do something that helps the sitting administration in the short run. In the long term, price is paid by the public in terms of higher inflation and lower real income. So it's really not the path you want to be going down. Very hard to say in terms of the very short term. I mean, what happens even if Powell were to step down? I don't think it really changes things dramatically in terms of where the Fed is headed here, given that it's a committee and the administration's not going to be able to completely politicize a majority on the committee anytime soon. That said, it's really a move in the wrong direction. It's totally inappropriate, and they should just stop it.
Mike, just to put a bow on it, given all the risks we've talked about, why are market-based inflation expectations so well anchored?
Well, I think they're well anchored because the Fed has achieved quite a bit of credibility here, right? I mean, they obviously had a big goof in 21-22 where we had inflation shoot up to 40-year highs. But, they ended up correcting that with 550 basis points of rate hikes, and were somehow able to achieve a soft landing, avoid a recession, and now inflation has come down to much lower levels historically. So the bond market is giving the Fed the benefit of the doubt. The institution has really regained and re-anchored its credibility, and that's another reason not to tamper with the Federal Reserve in a political way, because if that credibility is lost, it could be very difficult to re-achieve. They certainly got very fortunate with this episode a few years ago. Why keep playing Russian roulette with credibility? It doesn't make any sense whatsoever.
Mike, appreciate your time. It's been too long. Let's do it again soon. Michael Darda there of Roth Capital. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahira. Hey, Yahira.
Hi, John. We start with the latest on the flood disaster in Texas. The search for victims has resumed along the Guadalupe River after recovery efforts had to be put on hold yesterday following another round of heavy rains. More than 160 people may still be missing after the July 4th floods that left at least 132 people dead. Meanwhile, President Trump will head to the UK for his second state visit of his current term. In September, King Charles III will host the president and the First Lady at Windsor Castle from September 17th to the 19th. Trump called the invitation an honor and said the king was a, quote, beautiful and wonderful man. And 24-year-old Aussie Grace Kim produced one of the most impressive comebacks in golf to win at the Evian Championship in France. The former Youth Olympics champion recovered from 4 shots behind in a dramatic final round to defeat the world's number 2 Gino Thitikul. In Kim's 3rd season on the LPGA, she only had 1 top 10 finish in her previous 11 starts. That's your Bloomberg brief, John.
Yahira, thank you. Appreciate it. Thanks for this morning. Up next on the programme, we'll set you up for the week ahead. Plus, Mark Cabana of Bank of America as the pressure builds on Fed Chair Jay Powell and why they don't think this Fed cuts this year.
I'm still relatively optimistic we'll land somewhere with the European Union. The Mexico letter was a bit of a surprise to me, given that they weren't negotiating one of these full reciprocal deals. It was really about steel and aluminum. But that said, we've got 2.5 weeks to go, and I expect to see a bunch of deals. And for those countries that don't have them, I expect to see those tariff rates go up.
That was the former senior White House trade advisor Kellyanne Shaw. Her message this morning: the weekend's news is not for you. It's not for you. It's for trade partners. This is a negotiation. It will continue for the next several weeks and maybe beyond.
And guess what? The markets got the message before she even said it, because they said, look, we've seen this movie before. We're not going to freak out. We're still having a beer on the beach, and that's kind of where we are this morning.
No freak out at all. 41 minutes away from the opening bell. Equity futures negative by just 0.25% on the S&P. Similar move on the Nasdaq. Likewise on the Russell. The Russell, the small caps down by 0.4%. As we count you down to the opening bell, your week ahead looks like this, and what a week ahead. Later on today, President Trump to make a statement on the Russia-Ukraine war. Tomorrow, CPI plus JP Morgan, Citi, Wells Fargo kicking off bank earnings. Wednesday, PPI, more bank results from BofA, Goldman Sachs and Morgan Stanley. Thursday, retail sales plus another round of jobless claims. And heading into the weekend on Friday, Mitch, consumer sentiment. Fed Chair Jay Powell under increasing pressure from this White House. Mark Cabana of Bank of America writing this. Recent soft inflation readings raise questions of whether tariff inflation will emerge. If it doesn't happen by the September FOMC, the Fed may have to give up the tariff inflation ghost and start cutting. Mark joins us now for more. Mark, good morning.
Good morning.
That's not your base case, though, is it?
It is not the base case. The base case is that we will see inflation emerge, and we think we'll see some signs of that tomorrow. We think that what you will see in CPI is that there are a bit of uptick in core goods, especially with used cars. We think that you'll see some core services tick up as well. And we think that that'll give the market a bit of pause and cause the market to really ask itself, can we justify these 15 or so basis points of rate cuts that are priced in September, or almost the 2 full cuts that are priced by the end of this year? And we think the market will realize no. And then furthermore, on Thursday, when we get retail sales, our credit card data is pointing to a rebound in consumer activity. Our economists have core control, I think, at 0.9 month over month. Consensus is 0.4. So if you get both of those things, a bit of an uptick in inflation and signs that the consumer is stabilizing a bit, we think that there are very good cases for a market to start to question whether or not the Fed should be on hold. And let's not forget the fact that the most recent unemployment rate reading that we had was 4.1%. If you look at the full range of outcomes that the Fed has in the summary of economic projections, the lowest unemployment rate reading at the end of this year was 4.3. So we're out of bounds as far as a tight labor market is concerned right now with regards to the Fed's projections. So if you start to see this combination of data, then the market's going to start to pare back more meaningfully the almost 50 basis points of rate cuts by the end of the year. We think that'll result in some modest upward pressure on rates, some modest flattening bias on the curve. And we think it's going to justify our 10-year forecast for the end of the year at 4.5%.
So you believe in tariff inflation, not necessarily the ghost of tariff inflation. You're sort of rejecting the disinflation deity. I have to give you just a round of applause. Really, that was fantastic. Good job. But I'm just curious, at what point, if you do not see the inflation pick up, do you have to rethink your thesis?
Yeah, so as Jonathan noted, that quote that we posted, at some point, if you don't see it, the Fed's got to start to give up the ghost. And there are 3 CPI prints before September. September may well be the time. Now, I do think that we're all looking for tariff-related inflation. No one exactly knows when it's going to show up. There are anecdotes that say, especially if you talk to our retail analyst, Lorraine Hutchinson, she's been saying, why would you expect to see tariff-related inflation right now? Because retailers are still selling inventory that was acquired pre-tariffs. If you look at the most recent FOMC meeting minutes, there is a line in there that says something very similar. So the Fed is hearing this type of anecdotal feedback. And when we're all looking for something and we don't know where it is, call it a ghost, call it a deity, whatever you want to, I do think that those anecdotes really matter. And the Fed is going to rely a lot on those. And given how pronounced it showed up in the minutes, if you go back and read that tariff-related paragraph, it sounds like they're hearing this not just from 1 or 2 individuals in the economy. It sounds to me like they're hearing it on a pretty broad-based level.
So in the realm of hypotheticals, of ghosts and deities, there's this question of what happens if the Fed cuts rates by 1 or 2 times this year. And you do see that stickiness in inflation. What happens to the long end of the yield curve?
It should steepen. You should price more inflation risk premium, much more than you're seeing right now. And that's one of the reasons why we like being long intermediate tenor inflation. If you look at the inflation swaps market, or if you look at break-evens right now, much of the inflation is really priced in the first year or so. So the markets believe that inflation is just a one-time impact. It's going to come and go, and then we're going to be back at 2%, no problem. But I think what we're seeing is that you're not getting that one-time shock as cleanly as you thought, right? If you listen to Fed officials and most economists talk about inflation, it's a one-time shock that the Fed should just look through. But we're not seeing it as a one-time shock right now. We're collecting tariff revenue, right? It's over $100 billion that we're collecting this fiscal year. It's a lot more than last year. So the revenue is being collected, but we're not seeing that clean impact straight away. So why should the market think that we're going to see a clean drop-off in 1 year's time? The risk to us is that we see a more persistent impact of inflation, less sharp in the near term, but it very much could stick around for a while. And if you look at some of the supply disruptions that we had with COVID, we all looked at the supply chain disruption index. The New York Fed has one, others have some. It went up quickly and then it faded real fast. But inflation went up and then it stayed somewhat elevated. It came down quite slowly. And we do see risks that you're going to see that with inflation. And businesses are extremely thoughtful and savvy about how they pass this through. So why would we think that it's just going to go up and down nice and neatly? We don't. We think that you want to be long inflation in the belly of the curve. It's not pricing that type of outcome. And we do think that if the inflation sticks, it's going to be around with us for quite some time. It's going to make achieving 2% inflation for the Fed a lot harder than what the market is likely pricing right now.
45 seconds on the clock. You had a word there, the long end of the curve. I want an additional one from you on T-bill auctions versus coupon auctions. How's that going to change in the next 12 months?
Yeah, so we think, and our clients believe, that the U.S. Treasury is going to rely a lot more on short tenor issuance versus long tenor issuance. We titled our weekly this past week, The Wambulance to the Rescue, because I know you like that, don't you? I did. Katie Craig, shout out on our team. Great title. But the market believes that the weighted average maturity, or the WAM, of the U.S. Treasury debt will be going lower. And if Scott Bessent has been charged with lowering long tenor issuance, he doesn't have a ton of tools, but issuance is a really big one that he has. And so there's all this focus on WAM right now. And there was an extremely elevated amount of focus.
I wish I hadn't asked because I'm running out of time.
Okay, just give me a few more seconds. But
literally got 10 left and that's it.
Okay.
Then it goes bang and commercial break begins. Mark, I got to go.
Okay.
I appreciate it.
WAM, shorter.
Mark, Cabana. Thanks for America.